Good morning, friends. Okay, today I'm going to first start with theory discussion. Once I do little bit of theory discussion, I may go back to what we are usually doing. Now, I'll first set the context on why we are discussing theory so that you're aware and you automatically follow this from an exam point of view. See, the subject AFM may look like it's a practical subject, 100 marks of paper. You will be of the view that okay, everything is going to be practical paper, and I'll try to answer the entire paper by solving questions. Practical means basically solving question. Now, this is historical breakup of marks. I go with first mock test paper May 2024. 16 marks of theory was tested in the paper. In the 16 marks, leaving the internal choice and everything, 12 marks you will have to minimum attend. You will have to attend minimum 12 marks. Reason is question number 1, which is the mandatory 14 mark question, will have a theory component. Question number 2 again will have a theory component. Question number 3 again will have a theory component. Question number 4 again will have a theory component. 5 may not have a theory. 6 may not have a theory. Totally 6 questions will be there in descriptive. You need to answer 5 out of 6. Problem here is earlier, maybe some 10 years back when it was the 2 syllabus earlier, the 6th question used to be a full theory question. So what students used to do is they used to leave it in choice. Or when you are doing your CA inter, costing or FM, when you look at the last question used to be a theory question, and people were leaving that in choice, thinking that they'll be able to answer the practical portion, which is pretty much okay. But when it came to AFM, what is happening here is every descriptive question of 14 marks, out of the 6 descriptive question, at least 4 will have theory. At least 4 will have theory. So May 24 mock test paper 1, unless you attend 12 marks of theory, you cannot attend the entire 100 marks paper. Same happened with your mock test paper 2, and in exam, May 24 exam, 12 marks of theory was tested. They tested 12 marks of theory, and in that the student had to answer for 8 marks of theory if at all they want to complete the full paper. Somebody will say, no, I'll not complete the paper. That's a different story. If you want to write entire 100 marks of paper, 8 marks of theory was mandatory for you to attend in May 24 exam. November 24 was an exception where only 8 marks of theory was tested, and a student had to answer minimum 4 marks. He can answer 8 also, but minimum 4 marks you had to answer if at all you want to complete the entire paper. When it came in your May 25 exam, it went back to the normal level. 16 marks of theory was tested, 12 marks of theory was to be answered, and the same is the story in September 25 exam. In September 25 also the story remains the same. 16 marks of theory was there. I think 12 or 16 marks of theory. Broadly, you'll be answering 12 to 16 marks of theory as far as your exams are concerned. Now, why theory is critical? See, the paper as such needs minimum 60. Anything less than 60, I am not happy, and you should not also be happy about it. So, minimum 60 is needed. When I need minimum 60, securing 60 out of 80 is difficult. When I say 60 out of 80, if you ignore the theory part, you are indirectly preparing only for 80-85 marks of your paper, and with 80-85 marks, getting 60 is going to be very difficult, which is where theory becomes very critical. Theory does not mean you write your own words, you write your own way. All that is not going to be acceptable to ICI. ICI has not given marks if you randomly write points. Some logical points with some keywords from your institute study material is what they expect in exam. So if a student is not preparing for theory, they're indirectly saying that I'm okay to score 40-50 in AFM. That is what you're indirectly telling, that I don't want to prepare theory. Theory is something I am going to leave it in choice. When I say leave it in choice, you are indirectly telling that I am not going to be worried about scoring more than 50 marks in AFM. Many papers, when I've looked at the certified copies of the students, the difference between 50 and 60 will predominantly be the theory reason. Predominantly. Exceptional students can be there who have scored more than 60 without writing even theory also. Without writing theory, if you are an exceptional student, you may even score 80 also. That's a different story. An average student will find it very difficult. Will find it very difficult to score exemption. To score exemption in AFM if you don't prepare theory. This is point number one. When I looked at the certified copies of the students, what I also observe is MCQ people are able to score even 28, 30, but descriptive marks are not coming. In descriptive, they are not able to get the marks. Maybe some calculation error, maybe ICI wants something else in the answer. Some or the other issue keeps coming in the descriptive area. But in MCQ, the student is able to score marks, which means the concept is clear to him. But he is not able to apply that concept in an exam pressure situation, because of which some mistake, some rounding off issue, some calculation error, something keeps coming in, which also means theory becomes more critical. Because in theory, if you are able to score 10 marks, 10 are around 12 marks out of your 16, indirectly you make it very safe saying that MCQ I score marks, theory I score marks, descriptive obviously I'll score marks in few questions. I'll score marks. There are students of mine who have scored even 80s, 90s. Exception I'm not talking. I'm talking only about normal set of students who in an exam stress, will end up making mistake. Even in the class, when I go for rounds, I do see you making mistakes. So in an exam stress, obviously mistakes are going to be made. So theory is like a hedging tool. What is hedging tool is? It's a protection for me in case something else goes wrong. At least this will protect me and help me towards minimum 40 first, and then help me towards a 60. So first and foremost, most important thing is AFM is not fully practical paper. There is a theory element in this, and you need to prepare for theory. You are saying, you have attitude saying, no, I don't prepare theory and all, I know everything, I will not prepare, then I can't really help it. Theory needs its own importance to be given. You will have to give that importance to theory. If you are not giving the importance to theory, then it is going to become extremely challenging. So theory cannot be ignored. You have in front of you most of the papers, theory will be tested. Okay. You can go to your index section of your, in the question bank itself. I think it will be some page 468 or something. I'll tell you the page number. Yeah, come to the index section here, page 468. Page 468 of your question bank. Okay, looking at the past history, the most important theory chapters are the 5 where I've written some video and some time. Chapter 1, Chapter 2, Chapter 4, Chapter 7, Chapter 15. The most important theory chapters from an exam point of view. 1, 2, 4, 7, 15. 15 you can write P1, priority 1. 15 is the maximum priority. 15 is priority 1. Chapter 7 is priority 2. Chapter 1 is priority 3. Chapter 2 is priority 4. And chapter 4 is priority 5. These 5 are the most important chapter. This is my first priority. My first priority is chapter 15. Second priority is chapter 7. Third priority is chapter 1. Fourth priority is chapter 2. And this is the fifth priority. Why these are priority chapters? These are pure theory chapters. These are pure theory chapters. Other chapters will have practical area as well as theory. Chapter 15 full theory. Chapter 1 full theory. Chapter 7 full theory. 2 and 4 is also full theory. Some practical portion is there. But otherwise they are full theory based chapters. Till now, from May 24 till now, all exam questions have only come from these chapters. All exam questions, MTP questions and all have come from other chapters, but all exam questions till now have come only from these 5 chapters. I'm not giving any guarantee saying that it will come only from these, but these needs extra attention. Chapter 15, chapter 1, chapter 2, chapter 15, 15, 7, 1, 2 and 4. Whatever I'm showing in the screen is not there in your book, okay? Whatever I'm showing in the screen is not there in the book. This is a separate material which I've prepared just to explain the importance of theory. This you will not find it in the question bank. In the question bank, in page 468, an index is there. So in that index, you will have to mark your priority order. Chapter 15, then your chapter 7, then your chapter 1, then your chapter 2, then your chapter 4. Any doubts on this? This is the priority order. If past history happen same way, then questions will only come from these 5 chapters. In case your luck is not there or they end up testing something else, then can't help it. But otherwise, generally questions are going to come only from these 5 chapters from an exam point of view. Theory needs your attention. Again, I'm saying theory needs your attention. It is begging, saying that give me attention. People feel that theory, I don't want to prepare, I'll just throw it out. The amount of time we spend on a single M&A chapter, we spent around 20-25 hours. The same amount of time if you give for theory, the same weightage. When I say theory, overall, all chapters put together and a single big chapter of your practical area has the same amount of weightage from an exam point of view. It has same amount of weightage. In my classes, I normally don't cover theory, but in this batch, I have decided to cover few chapters and maybe few will come in the form of videos to you. I'll see what to do, but I'll at least cover few chapters in the class so that you at least understand the importance of the theory, because otherwise many students just directly straight away ignore theory. Clear? Can we proceed? So in the question bank, if you see this index, it starts with page 470, goes on till your page 549. After the chapter of startup finance is completed, after it is completed, I'll just show you. You will have something called a summary theory, which starts from page 558, goes on till 591. Summary theory notes are there and detailed theory notes are there. Initially, we will go through detailed theory. At your revision phase, you will go through summary theory notes. Around 40 pages is what you have to prepare to secure your 14 to 16 marks in exam. Will I get full marks in theory? Difficult, but there are set of students who have secured at least, if it's a 6 mark question, ICA has awarded even 5. Rarely they have even awarded 6. But theory people can score around 12 marks. 12 out of 16 is possible in theory. It is far better than scoring a 0. There are students I know who have scored 0 in theory because they have not prepared. They are very clear. We will not prepare theory. Despite telling so much, they are very clear saying that no, I will not prepare theory. Adamancy, I can't help it. So here from my page 558, summary notes will be there. This summary notes, you will see it later whenever you want to do revision. Whenever you are planning to do your revision or whenever you want to cover any chapter, quick coverage will happen through the summary theory. Now come to page chapter 15. That's the chapter I'm going to start today with. I'll complete chapter 15 maybe in the first 1 hour today. And then we go back to our security evaluation. In fact, I wanted to keep it at the end of the session, but I'm not able to estimate the time. So I don't know what time it will take. That's why I'm doing at the beginning of the session. We come to chapter 15, starting from page 549. You will be in listen mode. You want to make any notes, you can make running notes. But broadly, you will mostly be listening. In case you want to make some notes, it's up to you. Okay. Now, my explanation will come through a PPT. Okay, I have a PPT in front of me. With the PPT, I'm going to explain the question, explain the concept. You will be seeing your book. Okay, in your question bank, the discussion is there, and I am going to explain it through a PPT. I'll share this PPT later to you. Okay, first question: what is a startup? Okay, the chapter first. Let's broadly discuss the chapter. The chapter name is Startup Finance. Why did this chapter come into picture? Now, if you see from an Indian context or as well as global context, many startups are coming into picture. You may have seen a show called Shark Tank, where lot of startups pitch for funding. Lot of startups are trying to come out with some innovative solution. We saw a lot of startups growing from a small company into a big corporate, and the risks which are there in a startups are entirely different from the risk which you see in a mature kind of a business. For example, if I tell you that you'll have to invest in a startup, if I invest in 10 startup, only 2 or 3 will become successful. Balance everything, value can even become zero. In a startup, the value can even become zero. So the purpose of this chapter is to give a context as to what is a startup, why does startup need money, from where can it get money, because we are bothered about finance, from where can it get money, what are the sources of getting money, something called a succession planning, because in a startup, founder is the face. Once the founder is removed, how does the startup manage its business even after the founder exiting? So this is the broad context of the chapter. We are learning this chapter because post qualification, maybe you are working in a startup, maybe you end up working in a startup. So the purpose is, what does a startup do, what is the definition of a startup, how does it get money, from where does it get money, what are the different sources of investments it has, what are the risks which you see in startup. This is a broad discussion. The broad discussion of the chapter is around this area. In that, the first question I have is, what is a startup to avail government scheme or explain Startup India initiative? In India, government is encouraging startups. Government is encouraging startup. If you see, as I said, you will be only, this is the explanation, this is the material which you will be using. My explanation will flow from a PPT. You can look at the material whenever I tell you that please look at the material, otherwise be in lesson mode. For example, this question has come once in exam, November 23 in exam. Otherwise, November 2019, November 23, 2 times it has come in exam. Many times in MTP, many times in RTP they have tested. In exam already 2 times it has come. Now let's discuss the question. Okay, as per the Government of India definition, there is a definition there is a notification which came in the Startup India initiative. They have defined a startup. First, it can only be a private limited company or a partnership or an LLP. Public limited company is not allowed as per the definition. As per the definition, it's a private limited company or a registered partnership or a limited liability partnership. Why public limited is not allowed is, startup normally risk is on the higher side. So maybe government doesn't want to encourage the public putting in money there. Because the money can even become zero. In a startup investment. Age, 10 years is the time period. So today in 2025, any startup which is incorporated before 2015 is not a startup. If you have incorporated before 2015, 10 years is the time period. Incorporation not prior to 10 years. This is the time limit decided. Turnover should not exceed 100 crores in any year. If you are a startup today and in the current year if you cross 100 crore, you will not be recognized as a startup after that. You will not be recognized as a startup moment you exceed 100 crores turnover. This is as per the Startup India initiative definition. Originality. What is originality? TCS. Let's take the example of Tata Consultancy Services. TCS has 10 segments. One segment is a very small segment. It is only 50 crore turnover. What TCS did is, it demerged that small segment and made it as a separate company. It's a private limited company. Separate private limited company. Incorporated only 2 years back. Turnover less than 100 crore. But must not be formed by splitting or reconstruction of an existing business. You cannot split your existing business into 1 to 10 parts and make everything less than 100 crores. That is also not a startup. startup. And the last thing is focus of a startup should be innovation, new products, new services, new technologies. This is what a startup should bring. It should bring new products, new services, new technology. One example which I have is artificial intelligence based healthcare diagnostic. What is artificial intelligence based? I do a test on my body. It gives me a lot of parameters. With the parameters, AI tells that after 5 years, there's a possibility that you may get sugar. There's a possibility that diabetes can come to you after 5 years. Please take caution now itself. Or it can say there is a risk of heart disease after 10 years, after 8 years. If at all an AI can give this, maybe there are AI around that also now also in the practical world. But basic thing is doing something which is not there already. I want to do coaching for CA institute, CA students. That can't be a startup. That can't be a startup. Now I come with certain innovative way of doing classes. I don't know. I'm not able to think, but if there's some innovative way of taking classes, which makes it very easier for students, then maybe it is a startup. Then maybe it is a startup. Now, why this definition is needed or why? Because startups are eligible for one, I think some income tax benefits are there. Apart from the income tax benefits, certain other benefits are also there from a compliance point of view. There are, for example, in your labor laws, certain compliances are not applicable for a startup. So they get a lot of benefits from this. That is where the definition is given. The definition basically tells what is a startup, why this definition is needed. This is given in Startup India initiative. The definition came from there. With this definition, we are able to decide whether you are a startup or not. There are four major conditions. One, your legal structure, partnership firm, private limited company, LLP, participate, partnership firm, private limited company, LLP. Age is how many years? 10 years. Turnover should not exceed 100 crores and no reconstruction of existing business, and it should focus on innovation, new products, new technology. Why are we this definition? This will ultimately tell whether you are able to get tax benefits and other allied benefits. Clear? Any doubts on this? Now, if I go back to your theory material, read this question only. Read this question and tell me, is it a startup or not? NIA Healthcare. Read that NIA Healthcare. Read the question. NIA Healthcare is a proprietary concern engaged in the manufacture and development of pharmaceutical products since last 5 years to scale up business operation, increase the present turnover, which is hovering around 500 million. Around 500 million. Proprietor decides to convert the existing business into a private limited company. He also wants to get access to various tax benefit, easier compliances under the Startup India initiative, get recognized as a startup company, advise whether NIA Healthcare can be recognized as a startup company in view of the criteria considered eligible for the startup recognition initiated by the government of India. Think through for a minute and then we will discuss. You think through for a minute. Okay, does it fulfill the turnover condition? Participate guys, does it fulfill the turnover condition? 100 crores is the limit, 500 million is 50 CR. Less than 10 years, less than 10 years. Only problem is it is reconstructing your existing business. It is reconstructing your existing business into a private limited company, which somebody may debate saying that no, it is just a proprietorship becoming a private limited company. You can debate on all that, but I think as per the definition, reconstruction of existing business. If you see, NIA Healthcare is converted into a private limited company. In other words, there is a reconstruction of an existing company business into a private limited company. In view of the above, this cannot be recognized as a startup company. Clear? Any doubts on this? Why we want recognition as a startup is tax benefits and easier compliances. I move to the second question. What are the major reason for the development of startups in India? This has also come once in exam. This will be question 2 in your material. Now, if you look at, there is a map in the side, which the map is not very clear, but the map basically indicates that how many startups are there. For example, Maharashtra has some 18,634 startup. This is recognized number. So startups are growing increasingly. There is an increasing number of startups available in the practical world. Why startups are increasing in India? Multiple reasons are there. First, government support. Government has launched the Startup India scheme. Second, there is also something called as fund of fund for startup. What is fund of fund is? This fund will give loans or will give money to the startups, because the major thing a startup needs is finance. Without finance, it is difficult for them to proceed. So this finance can come from this area called fund of fund for startup. Second, India has diverse talent. Their talent force is unlimited. There are IIMs in India, there are IITs in India, chartered accountants. Many of them, instead of getting into an MNC, may work on a startup, may work directly on a startup. I think 3-4 batches back, one of the student of mine, he cleared chartered accountancy, but he's still now working on a startup. He wanted to do something on credit analytics. He's working on that startup. Instead of working, maybe finance money problem is not there for him, so he's ready to take that risk initially, and instead of going into a proper MNC work, he is working on creating a startup which will give employment to a lot of people. So pool of talent is there. Other element is, in India you can get workforce. Around 1 crore people join workforce on an annual basis because of the huge population India has. This indirectly makes it easy for companies to get cost effective workforce. When you get cost effective workforce, it is easy for us to compete with others, and that also led to growth in startup. Internet penetration is, before Geo came in, the penetration was on the limited side. But after Geo came in, India currently has the second largest internet user base. Because of this largest user internet base, it makes it easier for the startups to attract wide variety of customer, because startups will mostly be using newer technology. Newer technology will need internet from the user point of view. From a user point of view, internet is very much needed. uh, I think my niece had some eye issue. There are technologies which are coming for treatment of eye. There are some softwares people develop where at home she can do an eye therapy. Earlier what used to happen is, she used to go to manually to the place, travel around 30 minutes, go there, get a eye therapy done and come home. Certain technologies got developed. Because of that technology, she is able to do the therapy at home. But the most important element is internet. Without internet, none of this is possible. The internet is the main connecting point. If internet is not there, then those startups would have died. So India major growth is also because of internet accessibility. Emerging technologies, new technologies keep coming in. There are names like artificial intelligence, blockchain, efficient data processing. All these are coming. I'll give you an example of artificial intelligence. The PPT which you see, I did not prepare. This PPT is AI based PPT. I have not prepared this PPT. I just uploaded my PDF. I gave certain comments. I made changes, but the entire PPT which you see now here is basically made out of an artificial intelligence prompt which I had given, and it has given me this PPT. If the same PPT I had to prepare, it will take good amount of time. It is going to take good amount of time. So newer technologies make it very easy. Make it very easy for a person to develop things. And if I want to develop a startup, these newer technologies will make it easier for us to work on anything which a startup is trying to solve. As I said, that healthcare example, understanding after 5 years what can happen to a person, maybe an artificial intelligence tool can look at past data of millions of patients. It can look at past data of millions of patients and do something called as predictive analytics. What is predictive? It is predicting what is going to happen to the health of a person. Funding variety. What is funding varieties? Money availability. Earlier, money availability was limited. Now, money availability is becoming more and more. If at all you have seen this show called your Shark Tank, or I think in Tamil also there is a version available. So all these are coming into picture. Why? Because startups are growing. There is an increasing number of startup. When you have so many startups available, funding is also very, very critical. So this is the reason for sustainable development of startups in India. 6 reasons. Please talk. Please tell. First reason is what? Government support. Second, we have a diverse talent force like IIT and IIMs. The third one is cost effective workforce. The fourth one is your emerging technologies. Then you have internet penetration and funding. Funding availability is not a problem. Third question. What are some of the sources? Some of the sources for funding a startup. What is funding a startup is where is the money going to come from? Startup. The first source is myself. Personal financing. If it says skin in the game, what is skin in the game is I develop a startup. Startup needs 5 CR. I put only 1 lakh and ask all of you to put the balance money. All of you to put the balance money. I need 5 crores. My money 1 lakh. All of you put the balance money. Lot of people, I get the money. When I do this, if the startup fails, I am not bothered much. If the startup fails, I am not really bothered much. I am putting my time and all. But if it fails, I may not worry much because my only 1 lakh is there. Mine only 1 lakh is there. So many people say initial capital you bring from your side. Initial capital you bring from your side. If you bring from your side money, use your own savings account funds. Use your personal sources. Bring the money. After that is brought in, others will give money. Others will give money. This also in your ratio analysis called debt equity ratio. What is debt equity ratios? I will give debt if there is a equity from your side. If there is a equity from your side. Second, this is personal financing is using my own money. Personal credit is I have a startup. Startup is not able to take a loan. Startup is not able to take a loan. I take a loan at my personal end. What loan I take? Maybe a credit card loan, or I take a personal loan, or I take some other loan and use that money for my startup. Use that money for my startup. Personal credit. Personal credit. The third main source is family and friends. These are the initial sources for a startup. The initial money can only come from these 3 places. Either your own money, or take a loan, or third, family and friends contribute money. Family and friends contribute money. An example is soft loan from a parent. My parents give me some money to do my startup. This is the initial sources. Once these initial sources come in, then you have multiple other sources coming in. Peer-to-peer lending. Peer-to-peer lending, it's called P2P lending. There are certain lending platforms which are available in the practical world. An example is FairCent. If you want, you read about it later. In the peer-to-peer lending platform, what will happen is a startup will say, I am in need of money. It is an RBI recognized portal. It will do some credit checks. And if the credit checks are satisfied, money would be lent by this portal. Where is the portal going to get the money? Portal may get money from lot of investors and even individuals like you. If you are happy with what FairCent is doing, you may give your money to FairCent. FairCent will pay interest to you. FairCent will pay interest to you, and this money will be diverted to a startup. This money will be given to a startup. So you have peer-to-peer lending. In this case, only lending can happen. There's something called as crowdfunding. In crowdfunding, lending can happen, equity can happen, or donation can also happen. Lending can happen, equity can happen, or even donation can happen. For example, I am developing a startup. I need 5 CR. I go through a crowdfunding platform. What is crowdfunding is? All of you will give money. You are liking my idea and I ask you to give donations to me. Maybe I get donation. Maybe I get donation from people like lot of investors, or maybe I tell you give money, I'll give one equity share to each of you. I'll give one equity share. It could be in the form of equity, could be in the form of debt, could be in the form of donation. Peer-to-peer lending is only lending. P2P is only lending. Crowdfunding can be in multiple other ways. There is again a portal available like called Kickstarter. If you go through it, you'll understand. This portal does crowdfunding. It can help you in getting crowdfunding done. Micro loans, classic example is Pradhan Mantri Mudra Yojana. Pradhan Mantri Mudra Yojana, where small loans are given to people. With the small loans, a budding entrepreneur starts his startup. Maybe the money is not sufficient for a huge growth and all, but small amount of money is given, with which you are able to do your business or initiate your business. Also, we have vendor financing. What is vendor financing is, I buy raw material. I buy raw material from ABC Limited. I tell ABC Limited to give me credit. Moment, see what is funding is, what and all can come in your liability side. What is funding is creating liability in your balance sheet. Unless you create a liability, you cannot create an asset. So I want raw material asset. Against that liability is creditor. I create a creditor. With the creditor, vendor financing, manufacturer extending credit. PO financing. What is PO? Is purchase order. I give an order to you. For 2 crore rupees. I give an order to you for 2 crore rupees, saying that you are a catering company and 2 crore order came to you. So now you need to supply this 2 crores to me. To supply this 2 crores, you need to buy a lot of things. No, you need to buy some products and then do manufacturing. For doing this manufacturing, you need money. So there are certain companies where you show this PO, you show the purchase order, you show purchase order from Reliance Industries Limited. When you show this purchase order from Reliance Industries Limited, the company becomes happy, saying that okay, you have got an order from a reputed company. I am happy with this. I will give you a loan. And last is factoring. I think a name which you would be aware of. What is factoring is, your receivables are sold to an external agency and money comes to you. So there are 9 possible sources. Again, it can keep coming in exam. They'll say, what are the non-banking sources for financing a startup? First, my own sources. What is my own sources? Personal financing, personal credit, family and friends. Personal financing, personal credit, family and friends. Then after that, we have 2 sources. One is called peer-to-peer lending. Another one is crowdfunding. Apart from this, if you can get some micro loan, example, classic example, Pradhan Mantri Mudra Yojana. Apart from that, something on your creditor and debtor. What is creditor and debtor? On the creditor, you get some funding, creditor funding. That is called your vendor financing. On your debtor, when you get an order, you get a funding against that order called PO financing. And once the sale is done, for quick realization, we can do factoring. Any doubts till this? I give 2 minutes to you. You go through question bank, question 1, 2, 3. You can read all 3 questions. 1, 2, 3. 2 minutes, I'll wait. Okay, we proceed ahead. I go to question number 4. What do you mean by pitch presentation in the context of startup business? What is pitch presentation is, I come here, stand in front of you, you are the investor, explain about my company, and convince you, saying that you give me money. Again, I go back to the Shark Tank example only. There people come and do a pitch. The pitch will tell what company is doing, who is the promoter, what is the problem they are trying to solve, how are they going to do marketing, how much revenues are they going to achieve, who are the customers, what are the technologies they are using. So it's a small presentation, a short and brief presentation, usually less than 20 minutes, to investor to explain about the company and why should you invest in my company. What and all will it cover? A quick introduction. I'll give example, you'll understand. Okay, We are the Uber for tractors. Now the startup which I have is something related to tractors, okay? And what is Uber for tractors? Today you want to go from place 1 to place 2. You have your own car, you can use it. Otherwise you take car on rent. When I say car on rent, you just do it in Uber. A person comes, takes you from place A to place B. So I am, the startup name is Uber for tractors. Team, founders who is having 20 years experience. Next I'll explain about the founders. Third, what is the problem we are solving? The problem is many small farmers do not have money to buy a tractor, do not have money to buy a tractor. They need tractor for their farming purpose, but they do not have money. What is the solution? On demand machinery rental app. Whenever you want a tractor, just press an order, and immediately a tractor will come to you. This is the solution I'm trying to give. If at all a solution like this come, no farmer will be without a tractor. So you need a tractor, you need money. Money is not there. On demand machinery rental app. This is what I'm trying to give. Then in my pitch, I'll do the explain the marketing angle. What is marketing angle? I am targeting 50,000 villages in North India. This is the target I have. Targeting 50,000 villages in North India. So I'll come and only tell whatever is there in the bracket. The bracket is just for your understanding, okay? Examples are easy to understand. In exam, how do you write? With the keywords, okay? Projection. I want to achieve 100 crore revenue by year 2. I want to achieve 100 crore revenue by the year 2. This is what my projections are saying. Competition. I talk about who are the other people who are there in this business. Uber will tell there's a Ola, there's a Rapido, like that. Who are the other people in the business? Business model. I'll talk about business model again in some time. There's another question on business model. Business model basically tells how do you earn revenue? How do you earn revenue? Any idea? How does Jio Hotstar earn revenue? What is the revenue earning potential? Through subscription, anything else, and ads. These are the main sources, subscription and ads. So in their business model, their income comes from subscription and ads, and they buy content. They buy content which is streamed in their app. People view the content and automatically they get income. So business model will tell how is the income going to come from. Financing is the last angle we will have in a startup pitch. What is financing is, did I raise money, any money till now? If I have raised money till now, how did I use that money and what did I do with that money, and how much equity I have given to other people? If you have not raised money, then you will tell how much you have been able to achieve, even without money. So I come here and say, we are the Uber for tractors. We are trying to serve farmers. Farmers are finding it difficult to have a large machinery because of lack of money. I am bringing an application which will give something called as a tractor rental based on the order you place. We are targeting around 50,000 villages in North India. We are planning to achieve 100 crore revenues in year 2. Our competition is very limited, and our business model is, the farmer, whenever he takes on rent, he has to pay money to us, and we will be buying tractors and keeping them. And for this purpose, I need 100 crores from you. And for this, we will give you 10% equity stake. This is a pitch presentation. This is a brief pitch presentation which I have done. If you get convinced with the pitch presentation, obviously you will give me money. Clear? Any doubts on what is pitch presentation? In the pitch presentation, normally these documents may have to be added. In documents which, when not in the presentation, but these documents may have to be given to the other party. What are the documents? An income statement, maybe a cash flow statement, and a balance sheet. Your income statement, cash flow statement, and balance sheet. Income statement, I need not explain what is income statement and all. So income statement, initially when you are in the first year, maybe give me a monthly income statement. Initial period, give me a monthly income statement. Second, third year, maybe a quarterly income statement. Later on, give me annual projection. When you are forming a startup, initially give me data month-wise. Then later on, this is just a brief point, okay? What you follow, it's up to you. All these are just few pointers. So I need an income statement. I need a cash flow statement. What a cash flow statement does and all you are aware of. and I'll be needing a balance sheet which will list out the various assets and liability. With this, the investor will make a view whether to make investment in your company or not. Clear? Any doubts in this? This was the fifth question. Okay. Now, what are the modes for financing for startup? Now, what are the sources, modes of financing? To me, both are similar only, but I see as separate question. Okay, modes of financing is a separate question. Sources of financing is a separate question. We saw 9 sources. Modes of financing. When I saw it for the first time, I thought both are same only, but they have different names. Modes of financing. The first mode, they are talking about 3 modes. Bootstrapping. What is bootstrapping? Is building a company from your personal sources, building a company only from your personal sources. What is personal sources? Personal savings, personal credit lines, and maybe family and friends, one big startup, when it was formed, now it's a very big company, but one big company which did bootstrapping is your Zerodha, which is an application you may be using. That is a classic example of a bootstrapped startup. Classic example of a bootstrapped startup which did not raise money from outside people. I'm not sure today it has raised or not, but I think it has not raised money. It is a classic example of a bootstrapped startup. Angel investor, classic example, Ratan Tata. Ratan Tata, he had invested in multiple companies, or even take the example of Zerodha. Zerodha's promoter, the Kamath brothers, they invest in lot of companies. They are called angel investors. These people will provide capital through the early stage. They say often family or friends can also come under bootstrapping model. That's a view you can have. But angel investors are normally reputed people. They are reputed people who are investing in your startup. And the third one is venture capital. This is own source. This is basically a formal investment. A venture capital is basically a formal investment. Practical world, you may call it as private equity investment. You may call this as private equity investment. A venture capital may end up investing in my company. Venture capital will again give money for long-term purpose. Their focus is on rapidly growing company. Venture capital may not normally support at the very initial stage. At the very initial stage, money may not come from venture capital. Once initial traction, so by definition it says it can give initial money also, but once some traction comes, a lot of money will come from your venture capital funds. The angel investors, classic example here, Ratan Tata, who can invest in this. Any doubts on this? Okay, this came in exam. Define angel investor. Are these only individuals? There is a question which came in exam. Define angel investor. But are these people only individuals, or they can be a partnership firm, private limited company, a limited liability partnership? Definition: individuals who invest in small startup. I'll explain only if something is critical to explain. They provide seed capital. Seed is when you are initially growing a plant, the base is the seed. Without the seed, plant cannot grow. So initial money comes from these people, which is the first time injection or first time start. Regular money may also come in, but their main purpose is to give that initial capital, This capital can also come through crowdfunding platform, where I tell all of you, please give me money, you are my angel investors, you give me money. Practically, an angel investor can be any of them. LLC, limited liability companies, or LLP, trust can be there, investment funds can be there, corporate entities can be there, venture vehicles can be there. Individual is not the only point. It can be any of these forms. It is not an individual investor. Even Kamath brothers, they are investing, or when Ratan Tata had invested, he may have invested from one company or maybe from a limited liability partnership. I'm not sure. Normally not the personal investment. They will have one legal structure. From the legal structure, investments will happen. This is the answer to the question. Define angel investor. Are they only individuals? If not, list the entities. Now going back to your question bank, you please read 4, 5, 6, 7, 4, 5, 6, 7. I'll give you a minute or two. 4, 5, 6, 7. Okay, I go to the next segment, which is on venture capital financing. If you see mode of financing of startup, bootstrapping was one. Second was your angel investor. Third is venture capital financing. Venture capital financing is money provided by professionals. Normally, there are set of people. You could be working in a venture capital in future where you could be part of a company where I will come to you saying that I need investment. You will do analysis on it, and then money could be given from your venture capital to me. Money provided by professionals who alongside management invest in. Major focus of them is rapidly growing companies. It should be a rapidly growing companies. Now there are few characteristics of this. One is it is normally a long-term investment. Long-term investment. Ideally, you may have to wait for 3 to 10 years. If at all an IPO happens, you may get an exit. Otherwise, exit could be a question mark. Exit could be a question mark, or you find another venture capital. From one venture capital, money shifted to another venture capital. Lack of liquidity, it will be mostly private limited companies or unlisted companies. When it is unlisted company, selling my shares to another person is difficult. So lack of liquidity is inability to sell your shares. High risk, high return. High risk, high return concept is very simple. If you invest in 10 startup, every company you invested 2 CR, 1, 2, 3, 2 CR can even become 200 crores. 2, 3 CR can become 200 crores, and most of the company may even become zero. Most of them may become zero. If your luck is bad or luck or whatever, your analysis went bad, all 10 can become zero. All 10 can become zero and you will lose entire money. Or out of the 10, 5 can become successful, or 4 can become, even 2, 3 become successful. That is more than sufficient. That is what they try. They are thinking whether a 2 crore investment can become 200 crore or not. Equity participation, mostly they'll take equity. Along with that, they'll take active role in the management. The venture capital partners will be taking, when I say active role, not day-to-day operation. They could be part of the board of directors of the company. When they are part of the board of directors of the company, they will cross question you. They will cross question you in the board meetings. Every month there could be a review meeting. In the board meeting, you will have to give clarity to what the company is doing. So they are going to take active role in your participation. What are the advantages of bringing venture capital? See, if I give money to someone else, or a bank gives money to someone else, it's just money. Venture capital is money along with lot of other things are there. What are other things? They can give me access to lot of contacts. For example, Shark Tank. If you take the example of Shark Tank, whenever these people have invested, they have tried adding extra value addition, saying that we will give you contacts of so many people and that can help you in growing your business. So access to contact, they will become a risk sharing partner. They will guide me. They'll help me in setting up my processes, setting up SOPs, ensure that I don't get stuck at few places. Long term equity base, and they can give me future equity base also. Whenever I'm in need of money, future money can also come. It is money. Along with money, contacts can come. Their experience will help. Their guide will be there. Their team, they may have a team which can help my team in growing my business, and ultimately it can also help me in doing an IPO placement. In the end, an IPO can be done with the help of a venture capital partner, which will give an exit to them, which will ultimately give an exit to the venture capital partner. So these are the advantages of bringing venture capital into a company. These are the various stages in which a venture capital make investment. This came in one of the exam question itself, where this table was given in the question with certain question marks. So a venture capital may do first a seed money. Seed money is the initial capital they are bringing in. This is for an initial idea or an R&D stage. This includes extreme amount of risk. Extreme amount of risk. A 2 CR can become 0, 90% chance. 10% chance a 2 CR may become 200 CR. There's a 10% chance that a 2 crore may become a 200 crore. If you have been successful in this stage, then you get into a startup stage, then a first stage funding, second stage funding, third stage funding, fourth stage funding. Risk will keep going down. Risk will keep going down. Returns will also keep going down. Returns will also keep going down. When I invested at the seed money stage, value of the company is 10 crore. I gave 1 crore, got 10% stake. At this stage, value is 50 crore. If I give 1 crore, I'll get only 2% stake. At this stage, value could be 150 crore. Value is 300 crore. Value is 1000 crore. Value is 2000 crore. Value keeps going up. Your returns will keep going down. If you invest at the later stage, initial stage, if you make investment, you are indirectly helping an idea to become successful, but high risk, high return. Extreme risk, very high, high, sufficiently high, medium and low. Time period, initial 7 to 10 years, 5 to 9. You may have to remember these terms, okay? If at all it comes directly in an concept is very simple. Initial stages, if you invest, risk is on the higher side, return is also on the higher side. Then this is practically the process followed for venture capital. You are part of I am part of a venture capital company. You came to me saying that we are in need of funds, or I have lot of people, like I am tied up with some chartered accountants. I tell these chartered accountants that you tell me whenever any company needs money, So first thing is I need a deal. A deal has to come. I can directly source it, or I can source it through an intermediary. An example, referral from another founder. I have funded 10 companies. One of the founder gave me a referral of saying that there is a startup which needs money. Can you fund that startup? Once that comes in, I'll call you. After I call you, I will screen your initial proposal through my board. There will be a board. Later on at some stage, I know a student of mine who's part of the committee of the venture capital now. He is part of one company and he is sitting in that committee. So you could be sitting in the committee after maybe 10-15 years, where lot of people are asking for funding. You will screen that initial proposal, initial pitch review. Pitch review means either I come and do a physical pitch, or it could be a video pitch, or it could be a document also. With the document, I do my analysis. Due diligence, where a lot of big four and chartered accountants come into picture. You have given me so much information. I need to check whether the information is accurate or not. So I'll do a financial due diligence, tax due diligence, legal due diligence. All the checks will be done to check whether the documents provided are fake or real. After this, I will structure the deal. What is structure the deal? How much equity you will give me? When will you give equity? Is it in the form of equity? Is it in the form of debt? Is it in the form of convertible debt, convertible preference share? What are you going to give me and how is it structured? Then I will do a regular review, post investment activity. What is regular review? Every month I will ask you to give me your MIS, your management information system. Give me information on sales traction. Give me information on number of customer. Give me information on new products, new technologies, new services. And maybe I sit in the board also. And do the review. And ultimately, I need an exit. This is the process a venture capital will try to do. A deal will come to me. A senior board will review the deal. After the deal is reviewed by the people, a due diligence will be done by an external professional. I know people, friends of mine who are part of due diligence team. They will do, there are big four which has a division separately for due diligence. After the due diligence is done, if everything is fine, you look at that startup Shark Tank. A lot of people will say we are investing. If 40 deals have passed through, out of that 40, in the end only 10-20 deals would have passed through. There they'll say we are investing. After that a due diligence will be done. In the due diligence you may fail. In the due diligence it could be a failure. Structuring will be done. Post investment review will be done, and finally an exit plan is developed. Explain the structure of this venture capital fund. How are you going to structure the venture capital fund? There are two structures, okay? One is domestic fund. Second is offshore. Offshore means outside India. Domestic funds and offshore funds are an outside India fund. In domestic fund, India allows only trust or company. In India, only two forms are allowed: trust or company. In one of the exam, they asked, does limited liability partnership be structured as a domestic venture capital fund? Answer is no. This came in exam. It will be there in the book when you read it later. It will be there as one of the question. So your trust structure or company structure, in that also trust is preferred. Why company is not preferred? Company will have dividend taxation, lot of other taxation. I don't want all this headache. So trust is the preferred form. What is domestic fund? Domestic investors like you, me, are proper companies. What are proper companies? Kamath brothers. They want to contribute money to a venture capital fund, and this venture capital fund with some 10 professionals, 10 professional will do all the 6 steps which you saw above and make an investment. They will do all the 6 steps and make investment. My job is to give money only. My job is to give money. So raises money from domestic investor, invest in mostly in Indian company, invest in Indian company. Offshore funds, there are two structure. What is offshore fund? The fund is outside India. It is registered outside India. It is not registered in India. In India, because of your DTAA rules and your taxation rules, there are certain countries where if you are registered, lot of tax benefits are there. Lot of tax benefits are there. So maybe you register there. One is offshore structure. What is offshore structure is? Fund registered outside India, money coming only from outside investor, and that money is invested in Indian company. That money is invested in Indian company. Best for funds that raise money only from foreign investor, money from only foreign investor like US, UK and Japan, and want to invest where? In India. There's another structure called unified structure. Offshore funds are normally listed outside India, not listed, structured outside India. They are structured outside India. One is offshore structure where money comes only from outside India investor. Unified structure means money comes from both the people. Outside India investors are also there and inside India investors are also there. Both the money is pooled together into a locally managed trust. That is, the money is there outside India. The structure will be something like this. Fund, this is outside India. Lot of investor, Indian investor, outside investor give money. This money will invest in a trust in India, and from the Indian trust, ultimately money will be invested in so many companies. Money will be invested in so many companies. To put it very simple, there is a domestic funds and there are offshore fund. Domestic fund, domestic investor, domestic investment. Offshore fund will ideally have outside India investor investing in Indian company, where only outside investor, offshore structure. Outside India investor and Indian investor, you may have a unified structure. Any doubts on this? Again, I give you 2 minutes. You go through your, I think, question 8 to 8, 9, 10, 11, 12, 8 to 12. Okay, next set of question. I've decided to do bootstrapping. What is bootstrapping? Is raising my money from my own personal sources or from the operating revenues of the company. In this also, they are talking about what are the methods of bootstrapping. Method is basically using my own money. That's all. I'll have to use my own money. But in that also, few things they are talking about. It's little bit debatable points. One is trade credit. This is understandable. What is trade credit? Is taking creditor funding, not a loan funding. How will creditor funding come? Creditor funding will come in case I am a very well reputed company or my reputation is good. I may get credit. Leasing is I needed a tractor. No, tractor I need. One is to buy a tractor. If you cannot buy a tractor, go through rental mode. Factoring is like technically taking outside funding, but this is also part of bootstrapping as per ICI material. This is part of bootstrapping, but I can talk about this being a proper funding source. This is like what is factoring? You are aware. What is factoring? Is I sell my receivables to an outside agency and they give me money against it. Bootstrapping is good. Only problem with bootstrapping is lower growth. It is a very cautious approach. cautious approach and can lead to lower growth. When you have lot of money available, it is easy to grow. When money availability is limited, growth can be a challenge. There are set of people who are saying we are okay with lower growth. Classic example, Zoho. If at all you have seen what they do, the promoter is very clear. I don't want to raise any money from anyone. Mr. Sridhar Vembu is very clear that I don't want to raise money from anybody. I will have my own money. I will grow at a slow pace. I don't want any rapid growth and all. Whereas you look at your Swiggy, your Amazon, you look at all these, they want to grow at a very rapid pace. They are ready to lose money. They are burning money like anything. But there are people who are saying, no, I don't want this rapid growth and all. Slow, steady growth. I don't want an outside person to come and torture me saying that grow and all. So this is bootstrapping has benefit, but the only problem is it will lead to cautious and slow growth. Compare and contrast startups with entrepreneurship. Startup is basically bringing an idea into a product. Entrepreneurship is a broader concept which includes startup. In entrepreneurship, even startup is part of it. But what entrepreneurship try to do is, after that product is over, initial stage is over, you want to make it into a bigger success. Where the logic of entrepreneurship will come into picture. Entrepreneurship is a broader concept which includes startup as well as the post startup activity. When you are in a startup stage, your focus is more on innovation. You don't have a focus saying that I want to make profits. Entrepreneurs, they want to make profits. They are very clear. You have to make profits. Profit objective is 100% there. Without profits and all, no entrepreneur will be there. I want to make profits in the end. At a startup stage, focus on profits is not there. Similarly, here we are building from scratch. Once that built up is reached a stage, optimize your existing information, optimize your existing product, existing services is part of entrepreneurship. Then, what are the priorities and key challenges of a startup? This is also there in ICI material. Priorities is focus is more on need. Need means coming out with newer technologies, coming out with newer products, coming out with newer services. Today, I am teaching CA students. Because there's an opportunity existing for CA students. But if I try something innovative and try to bring something new for students, that is technically part of startup. Saying that if you do all of this, then this will improve your employment opportunity, something which is not even done by anyone. So if I try to do something to enhance your skills, which is really innovative in nature, that is the focus of a startup. Here, we encourage self-employment. We are encouraging self-employment. We want people to be self-employed rather than getting into your MNC and other places. In India, still some challenges are there. Though we have lot of talent, but the other challenge is talent is still not of right quality. Right quality talent does not exist. There are people who are ready to employ, and there are set of people who are unemployed. Both are not able to find a match because of skill issue. Regulatory cost. Government has lot of restriction, lot of compliance requirement. Because of these compliance requirement, you will have to comply with PF Act, you have to comply with Gratuity Act, you will have to comply with your sales tax, you will have to comply with GST, you will have to comply with Income Tax Act. So many compliances I do, my cost will keep going up. And break even is very difficult. Break even takes a lot of time. These are the key challenges a startup is facing as of now. I said I'll explain business model later. How a company generates revenue and makes profit. Example, PVR. PVR earns money mainly by selling movie tickets. To customer. Large part of profit comes from food and beverages sold inside the cinema hall. It partners with film producer to screen new releases. This is where my expenses are there, and malls for prime location. Some formats are there, all that is fine. So this is how PVR operates. Hotstar, simple idea, content like IPL, movies, some content is free with ads, some there is a premium content which needs a paid subscription. Money is earned from subscription and advertisement. Subscription and advertisement. Movie rental. Movie rental, they have given certain example. You can see this later. But what is the business model is how do you earn money? I used to work in a rating agency. When we used to work in a rating agency, I used to do financial analysis as well as business analysis. First thing my senior used to ask us, how is the money made by the company? You understand the business properly and tell me how are they earning money? What is that? For example, Bharadwaj Institute earns money by conducting face-to-face classes, by conducting live online classes, by giving your recorded classes, by selling books. This is what is our business model. How is the money being made? So in the startup pitch presentation, focus will be on business model. Focus will be on business model. They'll see, you will do all the presentation, everything. If at all you have seen that show, they'll ask suddenly, how are you going to make money? You please explain me. Where is the money going to be made? It could be rental income. It could be some other income. How is the money going to be ultimately made? Is the focus of business model. Peer-to-peer lending and crowdfunding, is it same? This came in one of the exam. This came in one of the exams saying that is peer-to-peer lending and crowdfunding same? Answer is no, they are distinct mechanism. Peer-to-peer lending mostly is for lending purpose. It is only for lending purpose. Lending means giving a loan, Crowdfunding is using social media and platform where it could be in the form of equity, it could be in the form of debt, it could be in the form of donation. It could be that I will tell, give me money, give me, there was one crowdfunding which can be done where I'll say, give me 1,000 rupees, all of you give me 1,000 rupees, I'm coming out with a new gadget. Once I come out with new gadget, I'll be giving the gadget first to all of you. You are the initial user of my product which I'm developing, but all of you have to give me 1,000 rupees. Whoever gives me 1,000, indirectly, I'm selling my product in advance to you. I'm selling my product in advance to you. That can also be an example of crowdfunding. Concept of unicorn. Unicorn is one which has a valuation of more than 1 billion US dollar, more than 1 billion US dollar, and obviously it has to be a rare company, customer focused should be there, and innovation is very critical. These are the critical key traits of a unicorn. You cannot simply become a unicorn. For becoming a unicorn, you need to be a extremely rare company. What is unicorn today? The valuation of around 9,000 crore rupees. The company has to have a valuation of 9,000 crore rupees. $1 billion is 100 crore dollar. 100 crore into 90 rupees is 9,000 crore. 9,000 crore should be the value. Small company and all cannot have. In the startup, in that Shark Tank, if you have seen, none of them would have been a unicorn. None of them would have been a unicorn. Unicorn is one which has a valuation of how much? 1 billion. In India, in Mobi, ad tech, this was the first startup. This was the first startup. After unicorn, we have something called as decacorn. Deca is 10%, 10 billion. 10 billion. Uni is 1, deca is 10. So next one is decacorn, which has a valuation of greater than 10 billion US dollar. Greater than 10 billion US dollar. Any doubts on this? Okay. After the startup discussion is done, entrepreneurship discussion is done, ICI has discussed on something called as succession planning. This is a very critical item. Succession planning is extremely critical. Classic example, I'll tell you, Tata Group. Tata Group, they have done proper succession planning. They have ensured that there is, the founders were there, founders went out, or they took managerial role, or they took board management role, and then the next set of management kept on coming in. Tata Consultancy Services, Infosys, they ensure that what succession planning is, after promoter, who is there to take care of the company? Who is there to take care of the company? Lot of companies ensure that proper succession planning is done. There are some challenges in succession planning, and there are certain benefits out of succession planning. Identifying critical position, developing action plans for individuals to take care of those critical position. If you don't do succession planning, if you don't do succession planning, then there can be a struggle later on. Just to give an example, not very good example, but something which you can still relate. In cricket, there'll be a captain. If he is going to retire, for example, in India's scenario, Rohit Sharma is not likely to continue for a very long period, so he moved out as a captain. A new captain is in his place. Now he is giving his knowledge, passing on his knowledge to the new captain, passing on the knowledge to the new captain. So this guy, the new captain, is going to take care of the team for the next 10-15 years, or next 10 years, or next 8 years. Then once he becomes older, you will tell him that please quit your captaincy. You play like a player with some advisory role, with some advice. You guide the next set of people, so that when you are quitting, there is no big vacuum. We don't want a vacuum when a person suddenly quits and the other set of people are not able to take care of the business, which is what succession planning is doing. Succession planning is ensuring that you groom new set of people. Why should I do succession planning? Risk mitigation. What is risk mitigation? Suddenly founder quit the company. If you want a new person, practically it may take even 6 to 9 month time. It may take a 6 to 9 month time to bring in a new person. If the founder is not there at that time, what will happen? Second, talent pipeline. What is talent pipeline? I am part of a company. For example, you are part of a big four. Let's assume you are working in a big four. In big four, you are told that as you grow, you will ultimately become partner of a big four. You are given this promise. You are given this path. You are very happy. You are motivated, and you are there in the big four because you feel you can become a partner at some point of time and replace the existing partners. So it motivates you. Conflict resolution. What is conflict resolution? Is in case any leadership dispute happen later, if you have extra people add on, if you have other people available in the pipeline, one, it is possible to avoid this dispute, and second, even if dispute happens and you exit, there's another person who is ready to take care of the company. I think the person who has exited, boat, which is the investor, I think is Aman Gupta. I think he is exiting from that company, and there are other people who are going to take care of the company. He is the face of that company. But he is exiting from the company, and other people will take care of the company. Professional management will take care of the company. Infosys would have been founded by Narayan Murthy some 20 years back, 30 years back, but now it is a well professionally managed company. There is a proper board of directors, there's a proper management which takes care of the company. So unless you have the second pipeline, it is very difficult for the company to grow. These are the steps you will follow. Evaluate roles. Roles is which roles will need a leader. Maybe sales head is needed, maybe an R&D head is needed, maybe a production head is needed. Which are the roles which are very critical for the strategy of the company? Identify the skills which are needed and see if you have any internal person who can take care of that skill. If there's an internal person who can take care of that skill, great. If not, bring out an external person or bring an outsider to mentor these people, so that they can take care of the skills later on when a person exits. Exit is part and parcel of any business. I used to work in a rating agency. After 10 years, I exited. This next layer was already ready, saying that if you exit, we have a next layer who will take care of what you are doing. In your audit firm, if you exit, there's a next layer already available who is going to take care of your work. We don't want to struggle. Without one person being there. So if founder is exiting, next set of people should be ready. Or maybe founder's son, I don't know, whatever you do, but there should be a next layer ready, saying that who is going to take care in case. Now Zoho, if Zoho, the promoter, exits from the company, I don't know, outsider, I don't know whether they have the next layer ready or not. Maybe in their company, they could be having the next layer ready, but you need to have that next layer ready. Otherwise, suddenly it will collapse. There will be a sudden collapse of the entire structure. Challenges in implementing succession planning. Founder mindset is, I am the founder. I say I don't want extra people and all. Please don't tell these people to come, I recruit a very good person. He is very knowledgeable. But as a founder, I don't give respect to him. When I say I don't give respect, I don't agree to his views. He is saying this is what we have to do. As a founder, I feel this is what has to be done. I don't agree to the views of these external professional, because of which the seasoned leaders may not be willing to join a startup. They may not be willing to join a startup. Second, succession planning and all is very good, but there is something called as process versus growth. What is process versus growth is, in the initial stages, don't tell me that I need to have proper processes and all. In the initial stages, let's just start proper processes and all. I don't want to develop in the first 5 years. Don't tell me do succession planning. In the first 5 years, let me make it a decent stage, then we will think about all these processes. From day one, if you think about processes, growth can become a problem. Growth can become a problem if you think about processes from day one. Processes will be used later. Processes will be used. And many places, founder is the face of the company. If founder exits, even after good succession planning, the value of the company may go down significantly. The value of the company may go down significantly even after good succession planning. This is what this entire chapter is all about. I will share this PPT to you later on. You can go through the PPT to understand broadly the quick points. How will you do it from an exam point of view? You will read all the questions once, twice, thrice, 4 times. You will read just a plain reading. I don't want extra things. Just do a plain reading. After your plain reading is done, what you can do is, you can go to the summary theory. In the summary theory, various points are there. You can read these various points and complete your preparation. For summary theory, my advice to you, sit in a calm place today. Sit in a calm place today. In your mobile phone, do the recording of this. You read in your own voice and do the recording. Definition of startup. Just read incorporated as either private limited company or a registered private. There is an error in the summary theory. Okay, not prior to, this was the earlier definition. Not prior to 10 years. Turnover does not exceed 100 CR. You just do a plain reading of this in a calm place. Entire chapter. The reading will take 15 minutes. You read it, record it. Keep playing that recording multiple times. Keep playing the recording multiple times. Whenever you obviously spend time on social media, you spend time there, you listen to music, sometimes listen to this, so that you are aware. That 5 chapters I want you to follow religiously. Other chapter and all not very critical. There you do whatever you want to do. So today at home, chapter 15, 3 pages. Just read it like this. Incorporated as either private limited company or a partnership firm or an LLP. You want to add extra points, you add it. That's up to you. That's up to you. But read it like this. After you have read this, you have done the recording. After the recording is done, keep playing that chapter. Keep playing. Students have told, sir, why don't you give me recording? Don't ask me everything. Everything I can't give. You also have to do something at your end. If everything only I have to give, then I'll write your exam. So ultimately, that is what is the last thing which can be done. So you do some things at your end. Go through these 3 pages. I was not even doing theory in the regular class. I used to give theory as video to students. This batch I felt maybe I'll do the theory also. That also not every chapter. I will decide to do few chapters. Everything will come to you. Everything will come to you, but some could be in the form of video. Some could be in the class. So we are done with this chapter 15. Later at home, do the recording and all. I will be taking a break, but before that, I'll just tell one thing. Theory is critical. That's the only point. You cannot ignore theory. You cannot ignore theory. Whatever I have done now, high probability 4 marks is done out of this. One question will 100% come from chapter 15. Very high probability. One question will come. 4 marks guaranteed. If you are able to write logical points. Logical points. Need to write these points as it is. Not able to write, that's okay. You cannot exact write words, but don't write some random things and all. If you can write exact words, okay. If you cannot write exact words, at least related points, right? PPTs will be given to you. PPT is just to do a quick reading, because PPT you are able to visualize the entire content, so that it's easier for you to read through and do it. Clear? And I'm being very honest, PPT I did not prepare There are artificial intelligence tools which does these tasks. You also try play around with these tools which will help you in other subject. My subject I'll give you, other subject you can take it. Okay, we'll take a break of 10 minutes and then we'll go to security valuation. Okay, in the previous theory session, I had explained the importance of theory, where I said certain chapters are extremely important. In that, chapter 15 is done. Now I move to the second most important chapter, which is chapter 7. Again, this is a full theory chapter. So in the entire material, there are few chapters which are exclusive theory. One of them is chapter 7 as well. Now, I'll first explain the term securitization. You can come to the question bank where this is covered. Page 507 is where it is covered. You open the question bank, and now I'm going to discuss the concept first. And as I did for the earlier chapter, I'm going to discuss it through a PPT. I'll share the PPT to you in the end. High probability a 4-mark theory question will come from this chapter. So let's understand what is this term securitization. That is what we need to understand. Once we understand the term securitization, then everything else is very simple. Let's see this with an example. Okay, there is ICICI Bank. Once we understand the term securitization, then I come to every question. Okay, ICICI Bank, their job is to give loans to people and accept deposit. So what ICICI Bank has done is home loan. It has given to 1 crore people. It has given home loan to 1 crore people. Lot of people like you, me have taken a home loan from ICICI Bank. What ICICI Bank is going to do? This in their balance sheet will be an asset. In the balance sheet, this item will be an asset. What will happen? Every month, you will have to pay your EMI and ICICI Bank will receive the money from you. You will pay EMI, ICICI Bank will keep receiving the money. This will happen for next 10, 15 years, 20 years. Home loan has a very longer duration. Suddenly ICICI Bank says, no, I need money immediately. I need money immediately. What purpose and all we'll discuss later. But I need money immediately. I tell the home loan customers, can you pay all the money today? They say very difficult, impossible. I have taken a loan of 1 crore rupee, 10 crore rupee, 5 crore rupee, 2 crore rupee. Plan was to pay it over a period of 15 years. Suddenly in one day you are saying you give me the money. I am now in a lot of trouble. So no customer will pay, and if I push for this, lot of NPS will happen. What is NPS? Non-performing asset. You will not be able to recover the money. Unnecessary problems will happen. But ICICI Bank is very clear. I need money. They are very clear. They are in need of money and you are not in a position to pay. I am also a home loan customer. I also can't pay. Both are struggling to make the payment. So what ICICI Bank does is it creates a company called ICICI SPV, Special Purpose Vehicle. It creates a company called ICICI SPV, Special Purpose Vehicle. Whatever name you want to give to that company, you will create another company. In this company, I prepare its balance sheet. In the balance sheet, that home loans were there, no? ICICI transfers from its balance sheet to the balance sheet here. ICICI says, from my balance sheet, I'll remove it. From my balance sheet, I will remove it, and home loans 1000 crore asset. Home loan 1000 crore asset is there in which balance sheet now? In the SPV balance sheet. Maybe you draw the diagram also. ICICI Bank, right? ICICI Bank. I don't know how you draw the diagram, but draw the diagram. ICICI Bank, home loan given to 1 crore people. You have the full page. Maybe do it in the landscape format. You will need a lot of space, okay? ICICI Bank, home loan, 1 crore people it has given. 1000 crore is the loan or whatever, 1000 crore is the loan it has given. In the balance sheet of ICICI, it is the asset. In the balance sheet of ICICI, it is the asset. It creates ICICI SPV. It creates ICICI SPV. And transfer the asset from the balance sheet of ICICI to the SPV. Clear? it has transferred this balance. Then I'll explain a various question and all. First, let's understand the concept very clearly. I transferred this to the ICICI special purpose vehicle. Now, I had some asset. I give it to you. Will I give it free of cost? Nobody does it. Nobody will give free of cost. So, this SPV has a payable. Don't write this, okay? Has a payable of 1000 crore. Don't write the payable, okay? It has a payable of 1000 crore. ICICI is saying, give me 1000 crore because ICICI wanted the money immediately. ICICI wanted the money immediately. I asked all of you, you are not ready to pay. So, I created one company. In the company, I transferred this asset. What this company will do is, it will collect capital. It will collect capital of 1000 crore from lot of investor. It will collect capital of 1000 crore from lot of investor in the SPV. In the SPV, lot of investors will put money. Who will put money? Some financial institution, insurance companies, banks, whoever has lot of money, they'll put this money in the balance sheet of this company. What will the SPV do? Collect this 1000 crore, transfer it to ICICI. Transfer this money to ICICI. ICICI very happy. They have got the 1000 crore. They have got the 1000 crore. So now what will happen is, this SPV, right, capital 1000 crore, capital 1000 crore collected from investor, and passed on to ICICI. Will it be exact 1000 crore? Can be more, can be less. Just a broad concept, okay? Collected from investor and passed on to ICICI. One of the investor can be ICICI Bank itself. They may put some 50-100 crore rupees in that. They may also put some money, and others will also put money. This entire scene is not even known to you. You are the customer. You don't even know that something like this has happened. What will you do? You will repay EMI. You will repay EMI. To whom? The SPV will collect EMI from you. The SPV will collect EMI from you. So SPV, when it prepares its P&L, this will give income. Against this income, SPV will return something to the investor in the form of dividend or interest. It could be in the form of dividend or could be in the form of interest. What will SPV do? SPV will collect money. Collect money from whom? Collect money from all of us. Collect money from all of us. ICICI Bank is out of the scene. ICICI Bank is out of the scene. What did ICICI Bank do? It had an asset of 1000 crore. It told you to make the payment. You said nothing doing, which is logical. How can I pay 1000 crore immediately? So what I did, I transferred the asset to the balance sheet of the SPV. I transferred it to the balance sheet of the SPV. Then I went to some financial institution, mutual funds, insurance companies, banks, fund managers, lot of private equity, and told them, I have this asset of 1000 crore. Can you give me money? On this money, I'll be collecting interest from the investors, from the people who have taken loan, and I will keep paying you as per the terms. There will be terms decided, whatever the terms and all, we'll see later. So, investor will be paid. Investor will be paid something out of the home loan income, something out of the housing loan income. This transaction is called securitization. This transaction is called securitization transaction. Any doubts first on the term securitization? Now, let's see it again. Who are the participants in securitization? Who are the participants in securitization? Originator. Is it visible? Not visible. Okay. Okay. Originator, initiator or securitization, sells asset lying in the book, transfers legal and financial interest. Example, ICICI Bank. ICICI Bank transfers this to the SPV. What did it transfer? It transfers the assets. It transfers the assets. SPV created solely to execute the deal. Created solely to execute the deal. Holds legal title. Remove assets from the originator's balance sheet. This is question number 3. You see that under later. Okay. Remove asset from the originator's balance sheet. Investor, buying of the securitized paper. Who are the investor? Mutual funds, insurance companies, financial institution, FIIs, DIIs, all these people will give the money to the SPV. All these people will give the money to the SPV. What will the SPV do? Transfer this money to ICICI Bank. Obligor. Who's obligor? You are the obligors. You taken the original loan. Original borrower. Original borrower who owe the money. Original borrower who owe the money is called obligor. The technical name is obligor. That 1 crore loan was there, no? All these people are called obligors. Rating agency. Now, ICICI Bank says, I want to transfer this asset to the SPV. SPV says, banks, financial institution, give me loan. Now, banks and financial institution are asking whether that loan is good or bad. How do I know whether the customers will make the payment, whether these people are already making the payment, NPA there, NPA not there, is it good loan, bad loan? Somebody has to analyze this. That will be analyzed by a rating agency. The rating agency will scrutinize the asset and give a credit rating. Give a credit rating, which can be a AAA rating, AA rating, A rating. This credit rating is basically on the loans which all of you have taken. So many people have taken the loan. That entire 1,000 crore loan, I analyze and tell whether everybody will make the payment. Some NPAs can happen, because if a lot of NPAs happen, investors will lose money. Investors will lose money. Receiving and paying agent. SPV will say, I don't understand this collecting money process from the customer and all. So can somebody collect the money? That somebody is called receiving and paying agent. That somebody is called receiving and paying agent. Practical world, receiving and paying agent will mostly be the originator itself. Who is originator? ICICI Bank. ICICI Bank will do the task of collecting the money. They'll do the task of collecting the money and will charge some fees for that. Will charge some fees for that. SPV is saying, I don't know how to collect money and all. You already have so many branches, so many people are there. Why don't you do the task of collecting the money from the customer? Collecting the money from the customer. That is called receiving and paying agent. Credit enhancer. I did the credit rating. I did the credit rating. Gave credit rating of BB. BB is a very bad credit rating. So the investor said, we are not giving this money. Entire deal will be called off. The investor is saying, we are not giving money because credit rating is bad. In this case, I may get some additional comfort. What is additional comfort is, ICICI Bank or some other bank is giving a guarantee saying that if these customers delay the payment or not make the payment, I will take care of the bad debt risk. I'll take care of the bad debt risk or NPA risk. If this comfort additionally is given, credit rating can go up and the investors will give the money. Investors will give the money. And last is, somebody has to do this entire process. He has to bring ICICI Bank. He has to bring ICICI SPV. He has to bring investor. All this together is done by an investment banker, which maybe in future could be you. You could be part of a company which is helping in doing the structuring. In the end, somebody has to structure the deal. Somebody has to say, ICICI Bank will transfer 1,000 crore loan to the SPV. SPV will get a credit rating done. SPV will find the investor who will help in doing this entire process. Some external professional. Some external professional. I'll explain it again. One, there's an originator, which is ICICI Bank. It has asset in its balance sheet. It wants immediate money. Second, SPV is there. What SPV is going to do? Transfer asset from here to the SPV and transfer in the liability side, issue securities. Issue securities to the investor. What form? Can be equity. Can be debt also. Can be debt also. Issue securities to the investor. Who are the investor? Mostly mutual funds, insurance company. There are obligors. Who are obligors? The people who have taken the original loan. People who have taken the original loan. The financial institution is saying, I don't believe all these people. So do a credit rating and come to me. Credit rating is bad. Some enhancement is needed in the credit rating. Some enhancement is needed in the credit rating. SPV is saying, I don't know to collect money, receive money. So an agent can come called as receiving and paying agent, which can be originator, can be others also. Can be others also. And finally, somebody is going to structure the deal. Any doubts what is securitization? Why this is happening is very simple. ICICI Bank needs immediate money. Why it needs and all, let's not debate on it. It needs immediate money. So it may transfer part of its assets to the SPV and tell the SPV to do this. ICICI in the past have given auto loans. What is auto loan? Is for auto customers, whoever is into transport business. Now ICICI wants to discontinue this business. They want to discontinue this business. All the auto loans, they will securitize and transfer to an SPV and tell the SPV to take the headache, saying that ICICI Bank says we don't want any auto loans in our balance sheet, so let's transfer it. This is the concept. Any doubts on this? Clear? Understood till this? Let's now come to question 1. Explain the concept and features of securitization. Securitization is the process of pooling and repackaging of homogeneous. What is homogeneous? Is similar. What is similar is do all home loans, do all auto loans, do all personal loans. Don't say I'll do personal, home, auto, all put together and do securitization. Homogeneous, illiquid. What is illiquid? You are going to pay over 20 years. You're going to pay over 20 years into marketable security that can be sold to investor. Into marketable security that can be sold to investor. An example, auto finance company has 5,000 car loan. It bundles them into a single pool of 100 crore. It bundles them into a single pool of 100 crores. Sells this to an SPV. SPV then issues. What is pass-through certificate? You will understand in some time. SPV then issues 1 lakh each. They issue a certificate with value 1 lakh to how many people? 100 crore divided by 1 lakh, so 10,000 investors are there. You could also try to become an investor if you are interested. Practical world, there are certain restrictions, but this is what SPV does. Any doubts? Features. Creation of financial instrument. What is creation of financial instrument? Is the loan which was there is now converted into a financial instrument. It has converted into a financial instrument. There are technical name called PTC and PTS. I'll explain that in some time. It is converted into a financial instrument. Creation of pool. As the name indicates, we create a pool of assets where we club what? We club the entire housing loan, entire auto loan, entire personal loan, entire whatever loans you are giving, you pool them. Bundling and unbundling. What is bundling? Is 10 or 100 home loans is clubbed and become a 100 crore bundle. Then bundle means aggregating. After you bundle it, you unbundle it by saying 1 lakh each security. You unbundle it by issuing security worth 1 lakh. Security worth 1 lakh. Bundling, aggregating into a pool. What is unbundling? Issuing securities of denomination against the pool. Issuing securities of fixed denomination against the pool. Any doubts till this? Homogeneity. What is homogeneity? Is that entire pool should either be home loans, should either be personal loans, should either be your whatever home loans, personal loans, education loan. All are home loans. All are credit card receivable. All are credit card receivable. Trenching. What is trenching? Is structuring the deal. What is structuring? Is after that 1,000 crore came in the asset side, I have to issue it in the liability side. When I issue it in the liability side, I can issue equity. I can issue senior equity. I can issue junior equity. All these technical terms not very critical for you, but I am going to issue different forms of instrument. What are the different forms? It can be debt, it can be equity. It can be debt, equity. Debt has low risk and low return for the investor. Equity has high risk and high return for the investor. High risk and high return for the investor. Marketability. What is marketability? Is ultimate objective is transfer some good loans, so that you can issue ultimately securities to the investor. If you are transferring some bad loans and all, no, it cannot be marketable. I have a pool where NPA is 20%. Nobody will take that. If NPA is 20%, transferring that doesn't serve any purpose, because no investor will invest in that pool. This is what merchantable quality. What is merchantable quality? Is the quality means those loans which are given, the end customer should have the ability to repay. I have a pool where I have given loans to Reliance, Anil Ambani companies and lot of bankrupt companies, and now I want to transfer this? Impossible. That and all doesn't make any sense. Who will invest in such type of a pool where all are bad loans? All are bad loans. Trying to transfer that doesn't make any sense. Liquidity means collecting immediate money. Collecting immediate money. ICICI Bank wanted immediate money. Any doubts on this? This is the features of securitization. First, I explained various parties to the securitization. Now, I explain the features of securitization. Any doubts on any of this? Any doubts on any of this? Explain securitization in India. What is securitization in India? Historically, how did securitization came into picture? This securitization in India came through Citibank. Citibank had started the concept of securitization in India by doing something on auto loans. Auto loans, they had given loans in the auto sector and did securitization of that as the first. Later, they expanded to aircraft receivable, sales tax receivable. Now you can do home loans, education loans, anything which is of a good merchantable quality. Good quality. Why are we doing this? I need immediate money. Why do I need immediate money? For giving further loans only. For giving further loans only. Market growth. After this started, it has been continuously growing by players like ICICI Bank, HDFC Bank, National Housing Bank. It reached a value of 1.9 trillion. 1 trillion is I think 1 lakh crore. 1 lakh crore. So it reached a value of 1.9 trillion in the value FY 2019-20. Certain regulations came in. Why regulations are needed? Mostly of non-performing assets. If there are any non-performing asset, who will suffer the loss? The SPV will suffer the loss. Investor will suffer the loss. So certain regulations came in. Because of the regulation, non-performing assets are also getting sorted out without the lot of legal formalities. Because of this also, the growth is there. And also foreign participation is there. What is foreign participation? Investor is needed. No. Investor, where is the money going to come from? That money can come from foreign participation. That money can come from foreign participation. What is foreign participation? Foreign portfolio investor, FIIs or FPIs. These people are giving money to the SPV. If SPV gets the money, securitization value will keep going up. Any doubts on the concept here? One example for securitization is also this. Indian microfinance institution. What is microfinance institution is? Those give small loans, 10,000 rupee loan, 5,000 rupee loan. ICICI Bank, as per the RBI regulation, will have something called as priority sector lending to be done. Priority sector 5%, 10%. So ideally, ICICI Bank should give loans to agriculture, should give loans to microfinance. They are not able to do it. So what they do is they call an MFI, microfinance company, and tell them that you sell your loans to me. You sell your loans to ICICI Bank. You sell the loans to the ICICI Bank is like an SPV there. You sell the loans to the ICICI Bank, and this helps the ICICI Bank to meet their priority sector lending target. It helps them to meet the priority sector lending target. ICICI Bank has a lot of money, so it tells the microfinance institution, you transfer this money to me. You transfer the money to me. Any doubts on this? What are the benefits of securitization? Some of this will be clear, easy to understand. Off balance sheet financing. What is off balance sheet financing is? I remove that asset from the balance sheet. Moment I removed the asset from the balance sheet, I got immediate money. I got immediate money. Whatever money I got will not be looking like a liability in my liability side. Whatever money I got, it is not a liability in my liability side. There are certain rules in Ind AS. I'm not getting into all that. Okay, a student asked me later. I'm not getting into your Ind AS accounting and all. I remove it from the asset side, and automatically I get the money without creating any liability. Without creating any liability. That is called off balance sheet financing. Focus on core business. I don't want this loan and all which I've given. I want to focus on my core business. My core business is home loans. I don't want education loans, so I'm removing the education loan and transferring. It will improve my ratio because my values goes up in the assets. Liabilities is not increasing. Automatically, capital is there, without any loans there, automatically my ratios will improve. And this can have a reduced cost also. What is reduced cost is, I transfer this to the SPV. SPV mostly will be ICICI own company only. SPV will mostly be ICICI own company only. This SPV will be able to take the loan at a very low rate. Maybe loan means investor. From the investor, they'll be able to take the loan at a lower rate, and ultimate beneficiary will be ICICI Bank. Ultimate beneficiary will be ICICI Bank. From an investor angle, who is the investor? Mutual funds, banks, financial institution. They get diversification benefit. What is diversification benefit? They want to invest in multiple things. They want to invest in home loans. How will I give home loans directly to you? So home loans is given by ICICI Bank, and I become an investor in the home loan portfolio. I become an investor in the home loan portfolio. Education loan is given by HDFC Bank. I become an investor in the education loan portfolio. Diversification. Regulatory compliance. I told you about that microfinance institution transferring their MFI portfolio to ICICI Bank to meet the priority sector lending. To meet the priority sector lending. Protection. Sometimes in the securitization deal, the investor will tell the risk of NPA will go back to ICICI Bank. The risk of NPA will go back to ICICI Bank. That is a protection I may add. And ultimately, it can give me good returns. As an investor, it can give me good returns. This is the concept. Any doubts on this? Any doubts on this? Okay, I'll wait for a minute. Read question 1, 2, 3, 4. You can just read at your end. 1 minute for you. 1, 2, 3, 4. Question 1 to 4, we are done. Please read all the 4 questions. Okay, mechanism of securitization. I think this will be easy to understand. Identification is the first one. Originator selects assets with similar maturity, interest risk, and frequency of payment. First, you'll have to identify which securities. Second, transfer it. Third, issue papers. What is issue papers? Is issue securities to the investor. There are 2 types of security called as PTC and PTS. I'll explain that in some time. I'll have to issue securities to the investor. Then I may need a credit rating. Technically, credit rating may happen even before the issue. Ideally, it will happen before the issue of security. Then after the credit rating is done, bad credit rating, credit enhancement. Then administration. What is administration? Is collecting the money. Who will collect the money? Receiving and paying agent. Who will be the receiving and paying agent? Mostly originator. For some fee, because he is not going to do free service for you. He is an outside agency. You are an outside company now. He may charge. And repayment. What is repayment? Is collecting money from the customers and passing on final money to the investor. What will SPV get? SPV will collect 100, pass on 2-3 rupees to the originator if he is doing the job of collecting. Investor will get 80-90. Balance 10 rupees could be the profit of the SPV. Which will be enjoyed by the equity investors of the SPV. In the SPV, there will be an equity investor, there will be a debt investor. What will debt guys get? They'll get interest. What will equity guys get? Balance money left over after meeting the commitments. So you can be an equity investor in the SPV. You can be a debt investor in the SPV. Any doubts on this? Any doubts on the concept? So very simple. Identify, transfer it to the other party, issue papers. What is issue papers? Issuing securities, do a credit rating, do a credit enhancement if needed, do the servicing and repayment. In the entire process, in case there is an NPA, this NPA may go back to ICICI, depending on the terms of the agreement. Clear? What are the problems in securitization? Though securitization has been growing, but there are certain challenges which the entire process is going through. First challenge is stamp duty. Some states charge a very high stamp duty on this transaction. The securitization transaction itself involves a stamp duty. Example, if Karnataka charges 12%, This is not the exact number. I'm just giving an example. Maharashtra charges 0.1%. Securitization in Karnataka is difficult. Securitization in Karnataka is difficult. Second is taxation and accounting. The accounting itself is a little bit of a debatable issue. Can you remove it? Can you not remove it? Is the ICICI Bank still has some risk? No risk? Can this asset be removed from the balance sheet, or it should be carried as a contingent asset, contingent liability? All those challenges are there. Uniformity is not there. They're just saying that there is no uniformity, and also challenges from a taxation side. What is foreclosure loss? Lot of legal laws are there. You have taken a home loan. You have taken a home loan. You did not make the payment. What should I do? I should come seize your property. But seizing the property itself is a challenging task. Seizing the property from you is a challenging task. Ineffective laws. Laws are not very effective. If the laws are not very effective, you are not worried to make the payment. When you don't make the payment, I suffer loss as an SPV, and ultimately investors suffer loss. So ineffective foreclosure loss. MBS means mortgage based securities. The process of securitization becomes unattractive in case these laws are not properly given effect. If you give it proper effect, no problem. But if proper effect is not given, the entire loss ineffectiveness leads to slow growth of securitization. Lack of standardization. What is lack of standardization? ICICI does standard securitization. It does its own form of documentation. The process is still evolving in India. So standardization is not there from an accounting point of view, taxation point of view, documentation point of view, because of which there can be a problem. Inadequate debt market. What is inadequate debt market is? I transfer to the SPV. SPV need money. People are not there to invest itself. People are not there to invest itself in the SPV. Unless there are people. Inadequate means it is still a developing market for us. In India, it is still a developing market. Also, I invested in the SPV. After investment, I suddenly needed money. What I would do? I would want to go to a stock exchange and sell my shares to you, sell my bonds to someone else. That secondary market is also not there. Secondary debt. What is secondary market is? I want to transfer to someone else. As an investor, I want to transfer. But there are no people. If this is the problem, I don't want to invest in the SPV. If SPV doesn't get money, how will securitization happen? Securitization can happen only. Growth is still there. It is a very evolving area. I used to work in a rating agency where we had a separate division for doing securitization rating, and highly profitable division in the company which I used to work, because huge growth is happening in securitization. People are doing securitization, but the question is talking about problems. There are 5 problems which ICI material talks about. One is stamp duty, taxation and accounting is not proper, ineffective foreclosure loss, lack of standardization, inadequate debt market. Okay. What are the various securitization instrument? First type you have to understand is there is a debt type, there's an equity type, which is a different story. In this, I can do PTC, pass through certificate, PTS, pay through security. This can lot of times this has come in exam. Pass through certificates and pay through securities. PTC and PTS. What is PTC is? As SPV collects money, it will pass on to the investor. You as the customer did prepayment of 1 crore. I will transfer this 1 crore to my investor, saying that I prepay your debt. You prepaid, I also prepay. What is PTC? You are paying me 1 crore. I'll pass on 99 lakhs to my investor. You prepay. If you are prepaying, I will pass it on. What is PTC is? Entire receipt is transferred immediately. As a customer, I had 1,000 customers. Somebody will do prepayment of home loan. I cannot stop you and all. You can do prepayments of your home loan. When you prepay, I transfer this directly to the investor. So investor carry a risk called prepayment risk. What is prepayment risk? Investor didn't even want money, but suddenly you are saying, I will pay you interest and principal also back, a part of the principal. He's saying, don't give me. No, it is PTC, I'll give you. It is pass through certificate. What is pass through certificate? Whatever money is collected will be transferred fully. What is pay through security? You did prepayment. I don't pay to the investor. I invest this money. And I'll pay as per the original terms of the agreement. What is original term? Every 1 year, I'll be paying 1/10 of the loan, 1/10 of the money to the investor. So here permits restructuring. SPV can reinvest the surplus fund. SPV can reinvest this is the core difference. Okay, this is the core difference. What is PTC? You did prepayment. I pass on the money to the investor. You are the customer, this side are the investor. You give it to me, I pass it on to you. They give the money to me, I don't pass it on to you. What I do? I reinvest. When will I give you? As per the terms. What was the term? Every year pay 10% interest and repay 1/10 of the principal. I'll pay as per the terms. So I can do reinvestment. And it allows me to create different tranches. What is different tranches is, some can have 2-year life, some can have 5-year life, some can have the security which I issue, 2-year security, 5-year security, 10 years. In PTC, as money comes in, money will come back to you. Be mentally prepared. If money comes from the customer, I'll pass on the money to you. This is first two type, PTC, PTS. There's another category called stripped security. It could be a subpart of PTC, could be a subpart of PTS also. But what is stripped security is, the investor who is investing in my company, I tell them that you will either get only interest or you will either get only principal. What is interest or principal? If I get interest from the investor, I'll pass on the interest income to you. If I get principal from the investor, I'll pass on the principal income to you. Principal, not income. Whatever principal I get, I pass on the principal. Holder receives only interest. Interest only security, principal only security. There are two types. Interest only security, principal only security. What is interest only security? I issued 200 crore interest only security to you. I issued 200 crore interest only security. This 200 crore, how I am going to repay? I will repay out of the interest income. I'll repay out of the interest income. What is out of interest income? 10 crore comes, I'll pass on 10 crore. 20 crore comes, I'll pass on 20 crore. Only payment out of the interest income. Only payment out of the interest income. I also issued 500 crore principal security. This 500 crore will be repaid out of the principal which is coming from my obligor. Out of the principal which is coming from my obligor. 500 crore means principal due could be 700 crore. So 700 crore will go back to the investor. 200 crore interest due could be 300, 400 crore. 400 goes to the investor. This is normally not preferred by the investor. Normally not preferred by the investor. Why is it not preferred by the investor? Very simple. Why I want this headache of only interest, only principal? Let me get both. So either it is PTC or PTS. What is PTC? Prepayments passed on to the investor. Prepayments passed on to the investor. There is a prepayment risk. You have a direct claim. What is direct claim is, as money comes in, money passes on. Here no direct claim. Different tranches. 2-year, 5-year, 10-year, 15-year, depending on what I want to do. How is the pricing of the securitized instrument done? What is pricing is, I transferred 1000 crore. Against this 1000 crore asset, would you pay me 950 CR, 1000 CR, 1100 CR, 1200 CR? What are you going to pay against this? What are you pay against this 1000 crore? I transferred 1000 crore asset. No, you have to transfer this 1000 crore to you and you need to give me some money. How much money will you give? From an investor angle, investor will want the SPV to pay 800, 900, 1000, 1100, 1200, whatever number. How will they calculate? They will tell the SPV to do present value of future cash flow discounted at WACC. Present value of future, or SPV will be getting future cash flow, first year so much, second year so much, third year so much, fourth year so much, fifth year so much. Discount the cash flow at the yield to maturity, and arrive at the value. This is what investor would want the SPV to pay. I am ICICI Bank. ICICI Bank will think in one logic. What is the logic is, if I transfer the asset, I am not going to get first year interest income. I'm not going to get second year interest income because I transferred this. No, I'm not going to get income. So whatever money you are paying me, when I reinvest this money, I should at least get that earlier income. I am transferring asset to you. When I transfer asset to you, you have to pay me 2000 crore. Why 2000? With that 2000 crore, I will give new loans and earn the interest earlier I was earning. So priced at a rate where the outflow can be amortized by investing over the amount raised. See, they have given different terms, but logic I'll explain. Logic is very simple. You have to pay an amount. Which can compensate the loss in income. What is the loss in income? 1000 crores loan is removed. You were paying me interest. What interest? Maybe 10% for a year. 100 crore I was getting. Now entire 100 crore is lost. So you at least give me some amount with which I reinvest and get 100 crore. This is the logic they are saying. Rate where the outflow can be amortized. They give something like this, but logic is what I'm explaining. Logic is very simple. I will invest the amount raised. Cost of funds versus the deployment return. What is deployment? I'll deploy this funds and get the money. What will SPV investor say? Give them. Very simple. SPV investor will tell, give them an amount which is equal to present value of future cash flow discounted at yield to maturity. Any doubts on this? There are risks in the securitization process. The first main risk is, all of you, when the customers are not making the payment, that is the biggest risk in the securitization. That's called credit risk or counterparty risk. None of the customers are making the payment. That is the biggest trouble. This happened in US 2008 subprime crisis. If you want, you just read about it, where a lot of loans were given and none of the customers were able to repay. The amount. Legal risk. What is legal risk? Is one, I transferred this asset to the SPV. No, whether that happened properly, not happened properly. Is there a dispute which can come? ICICI, can it claim that that loan is still in my books? That is one. Second, you did not make the payment. I'm not able to seize your property also. I'm not able to take back your vehicle also. Then that is the other risk which we have. Market risk. What is market risk? Is macroeconomic. Today, I have given loans to all of you. What happened is, Indian economy went through recession. Some of the customers lost their job. When jobs are lost, they are not able to make the payment. This is a market risk. A macroeconomic risk, where industry downturn has happened, because of which customers are not able to make the payment. If customers don't make the payment, I'll take another 10 minutes. I'll have to complete this. Customers are not able to make the payment. This will lead to default. Prepayment risk. What is prepayment risk? Is early repayment. Investor may not find the same yield again. In case of PTC, you pass on the money. When you pass on the money, they are saying, why are you passing on the money? I don't want this money. But you still passed on. Any doubts till this? Okay. Securitization has some linkage with a technology called blockchain. What is the linkage? You'll understand in the last question. A term which a lot of us may have heard, blockchain. It is a very big term. I'll just explain simple terms for us to understand. What is blockchain is, let's assume I create a Word document. Give access to all of you. Give access to all the people. Give access to all the students. When I give access, some student can start writing in page 1. They can start writing in page 1. Page 1 written, then page 2 will open. Page 2 can be written by any other person. Page 3, page 4, page 5, page 6. Page 1, if it's written and if it is okay, nobody can delete it. None of you have access, but you cannot delete the page 1. All the students are having access access to that Word document, you can write page 1. Somebody can write page 2, somebody can write page 3. That page 1 is called a block. One block, page 1. In the page 1, you will write some transaction. What transaction? We'll see later. You will write something in the page 1. If it is a okay kind, then it is over. Nobody can tamper that page 1. Nobody can edit that page 1. Nobody can make any changes to the page 1. Like this, page 1, page 2, page 3, page 4, page 5, page 6, page 7, page 8. Like this, millions of pages will go. This millions of pages together is called chain of blocks, blockchain. Chain of blocks, blockchain. Every page is a block. This page will have some transaction. What transaction? Simple example, real estate. You purchased a property. The owner details is mentioned in page 1. First property. Second property, another owner. Third property, another owner. Government is using blockchain technology where the owner details are mentioned in every page. It's not practically page, it's every block. In every block. Nobody can delete that. So if you are able to maintain this property records in a blockchain, nobody can do double registry. Nobody can create fake records. All those will get eliminated in the practical world. You will get access. Lot of people. When I say humans, practically you are not going to get access. Whoever has to get access to that blockchain will get access to the blockchain transaction. In a blockchain, every participant has copy of the Word document, Once data is written, it cannot be changed or deleted. No central authority. Nodes must agree on validity. Nodes means whoever are the participant. They have to agree on the validity. Where can it be used? One example they have given, supply chain. Supply chain, how it can be used? If I have a blockchain, for example, let's assume I'm buying milk. I go to a store and buy milk. That milk turns out to be bad. In blockchain, you'll be able to track which retail store the milk came. This retail store bought it from which factory. This factory got the milk from which cow. Ultimately tracking it to the cow and understanding there is some problem here. So maybe give treatment to that cow. Walmart uses blockchain, something else to track lettuce. In case there is any outbreak, some bacteria or virus outbreak, they can identify from which batch, which farm this has come, so that you do treatment of it. This is one place where blockchain can be used. Supply chain, real estate, smart contract. What a smart contract is? I set a rule. What is a rule? We have entered into a transaction. In the blockchain I have mentioned, if it rains today, I will transfer 1,000 rupees to you. Blockchain will track it. If it rains, automatically I'll transfer 1,000 from my bank account to your account. Automatically. Another example, insurance payout. Insurance payout is triggered automatically in case there is a delay of more than 4 hours. They are talking about something like smart contract means automatic execution. Why is the blockchain coming in securitization in the end? I'll tell. Finance. In finance, there are, for example, I want to transfer money from India to USA. Earlier, India will have to transfer to some in-between account, then it will go. Lot of transactions have to happen. If blockchain is there, in seconds the money will be transferred, and in the block, this transaction will be recorded. Dinesh transferred to someone else. My account value went down. Another person account value went up. There are also risks in the blockchain technology. The major risk is there is nobody sitting at the top. What is nobody sitting at the top? For example, if I have to use some accounting standards, how accounting standards are used? ICI is sitting at the top saying that you'll have to do it like this. In blockchain, who's responsible if something goes wrong? Who's responsible? If I give access to a Word document and I become central authority, I'll take care. But I am also a participant. You all are participant. Somebody did something with one of the Word document, one block. Something has gone wrong. Who is going to sort out this issue? Who will sort out the issue in case something happens? Second, control and monitoring is little difficult. In case my controls are not properly implemented, again it can go bad. In case there is a bug, who is going to sort out that bug is the biggest problem of blockchain in the current world. Reliability of technology. If that underlying technology itself had an issue, if the underlying technology itself had an issue, then again the blockchain can fail. And the last important part is skilled people are not there who understand blockchain. I have not understood blockchain till now. Again and again I've read it multiple times. Ultimately I've got some clarity, and that's why I'm explaining it. But still a lot of people don't understand what is blockchain itself. So who's going to do all this development? Finding competent people to design and performing this is difficult. Finding the competent people. Now you will understand why did blockchain come into picture in this chapter. It came because of a term called tokenization. What is this tokenization? Let's understand. But this came in this chapter only because of tokenization. Another 5 minutes and we are done. Let's see an example. There are 100 commercial building. There are 100 commercial buildings are there. ICICI, let's assume, has 100 commercial building as an asset. It's not loan, 100 commercial building. It transfers this 100 commercial building to an SPV and tell the SPV to collect rental income. Tell the SPV to collect rental income. That is practical world called real estate investment trust, REIT. It's technically called REIT, but this is a securitization process. What is tokenization is, I have a luxury apartment. The value of the apartment is 500 crores. It is a 500 crore. I wanted to sell this 500 crore value. No investor. I could not find any investor for 500 crore. Then I tell everybody become owner of 1 by 100. 1 by 100. What is 1 by 100? Pay 5 crores each. Pay 5 crores each. A single luxury apartment divided into 1,000 tokens. Divided into 1,000 tokens on a blockchain, allowing people to become owner of 1 by 1,000th of the apartment. This is where blockchain came into picture. Why blockchain came into picture is, you want to convert an illiquid asset into a liquid asset. One way is securitization. Another way is tokenization. What is tokenization? Converting that real estate property into a asset in the blockchain and converting into something called as 1,000 tokens. What is 1,000 token is? Every token gives you ownership of 1 by 1,000. 1 by 1,000. Process of converting tangible and intangible asset into blockchain token. Practical world, a painting can be converted into a token and sold to people. Liquidity, both give liquidity. What both liquidity? Converting the, ultimately this is why we have learned blockchain, to compare it with tokenization. Diversification. As an investor, I want to invest in real estate portfolio, but I can't buy 10 crore real estate building. So I'll buy 1 by 1,000. 1 by 1,000, or I can become a part owner of the SPV. Trading, it can be traded in the market. You can transfer your token to someone else and it will be recorded in the blockchain. Why blockchain? Because blockchain has the data which can never be deleted. It has proper information which can never be deleted. Opportunity, the financial institution may generate some income out of it. Whoever is doing this deal, it may generate some income for it. Again, I'm repeating, it's a very important thing. I'll close it with just one discussion. What is securitization again? Securitization is very simple. ICICI Bank is there. It has asset side 1,000 crore. It wants money today. Transfers to SPV. SPV has the asset. SPV will create a liability. What is the liability? Equity capital 100 crore. Junior debt 400 crore. Senior debt 500 crore. And this money will be passed on to SPV, to ICICI Bank. And SPV will collect money from all of us and pass on the returns to the investor. Clear? Any doubts on this? Do go through this. I'll share the PPT to you. With this, 2 important chapters theory is over. 5 important chapters are there. Mostly I'll do all the 5 in the class. Clear? Any doubts on this? We'll end with this. Thank you, friends. Good morning, friends. Okay, first today I'm going to start with another theory chapter. We are done with 2 theory chapters. Totally 5 dedicated theory chapters are there, or important theory chapters are there. We are done with your securitization part and the startup finance. I'll now move to chapter 1, which is financial policy and corporate strategy. Again, a chapter which is fully dedicated to theory. There are three fully theory chapters, two main theory and some practical is there, and others are practical and theory. So this is in page 470 of the question bank. I'll first quickly discuss a broad overview what we are doing in this chapter, and then we go through various questions. Now, the chapter is very simple. The focus of the chapter is what is financial policy? How do you decide financial policy? What is the use of the financial policy? What can an organization achieve by following a financial policy? How can an organization become something called as sustainable? Sustainable means staying for a very longer period. If you go back to history and check, maybe 40 years back or 50 years back, 100 companies were there. Out of those 100, today maybe only 20 survive. Lot of companies go out of business, become bankrupt because of some company which are been extremely famous when our parents were growing, but now those companies may not even exist itself because they were not sustainable. So somewhere a focus on sustainability will come, and something called a strategy. How does an organization develop a strategy? What is financial strategy? What is corporate strategy? So certain elements around that is what the focus of the chapter is all about. At CA Inter, we learnt something called as role of a financial manager or a chief financial officer. There, when we would have learnt that, we saw that CFO main focus was on something called as wealth maximization. The role of a CFO is to enhance the wealth of an organization. That was called traditional role. Explain about the advanced role of CFO in various matters, including wealth creation. This is question number 1. The CFO's role earlier the role was primarily focusing on wealth maximization. Wealth maximization means increasing the wealth of the company by following certain policies which enhance the wealth of the shareholders. We used to have two principles. If you remember, there will be something called as profit maximization and wealth maximization. Now the CFO is not a person who's only bothered about wealth maximization. He is a person in the company who will have a say on multiple things. He can even talk on something called a supply chain management. What is supply chain management is, how does the product from a manufacturer reach the end customer? There are different ways it will reach the end customer. That's called supply chain management. A CFO may focus even on that, even on something called a supply chain management. Focus on risk management. Because of the growth of technology, an organization is now impacted because of various risks. You can get impacted because of a technology risk which is there, or a cyber security risk which is there. All these roles are available with the CFO. He is going to take care of the technology part as well. M&A restructuring. M&A is mergers and acquisition. Structuring or restructuring, whatever way you want to call. You can do a merger, you can do an acquisition, you can do a demerger. All these places, the CFO plays a predominant role. There's one more item which is coming now called as ESG financing. What is ESG financing? Is environmental, social and governance based funding. Many companies in the practical world issue something called as green bonds. What is green bonds? Is those companies which comply with all the environmental norms, social norms, and take care of the governance within the company. You will learn this maybe in your SCPM subject. There's an area called triple bottom line, which is called people, planet and profit. An organization earlier focus was just making profit. Now only profit and all will not work. You have to take care of the environment. You have to take care of the environment. You have to take care of the society at large. Societal consideration. What is society? Is doing good for all the stakeholders. A stakeholder can be employee, can be customer, can be supplier, can be shareholder. You need to take care of all the set of people. So these are the newer roles which a CFO is going to perform now. Earlier, wealth maximization, just focus on financial angle. Just a practical example, a CFO of a technology firm today just doesn't manage books. It is not just managing books of accounts. What is managing books of accounts? Recording of transaction and ultimately declaring the results of the company in form of financial statement. He may decide on investing on green data center. Data centers are those which takes the information, where the information is stored. Green data center means no major impact on environment, and hedging against the cyber security risk. Cyber security risk are because of the technology improvement. I think a lot of us are aware. Suddenly a link will come in your mobile. You click the link, your mobile gets hacked. Because of that, you may lose the entire money which is available in your bank account. So many risks have started coming in. Lot of times, suddenly a message will come saying that there is a fine of rupees 100 on your traffic violation. Pay the fine. If you click that link, you will see that was a bogus link, and moment you click it and give some information, your account will get hacked, and after that they will get access to your account, send information to other people. So a lot of risks have started coming in. A corporate has to protect itself from these risks, and CFO may have a role in that as well. Clear? That's the first question. Explain the role of an advanced role of a CFO. Earlier, wealth maximization. Now we are going beyond wealth maximization. At any stage, whenever you're going to revise theory, you'll first read the PPT once, and then you can quickly go through the question, because the PPT will give you a broader view of the question. Next, what are the three elements of any business? Three elements of any business is SFM. We used to earlier call the subject as strategic financial management. These are the three elements. SFM is, S means for strategy, F for finance, and M for management. Without SFM being there, a business can't survive. What is SFM? Strategy. Strategy is what I want to achieve and how am I going to achieve it. How am I going to achieve it? Lot of linkage is there in this chapter to the SCPM portion, because unless that is clear, this may not get you good clarity. There you will learn something called as vision, then there's something called as mission. Based on this, objectives will be prepared, and based on the objectives, something called as strategy will be decided. This is how normally happens. At the top there is a vision or a mission. Based on that, corporate objectives are decided. To meet the objectives, I need a clear and a realistic strategy. I have a good strategy, good business, but still I go to Shark Tank India because I don't have money. I don't have money. Without finance, nothing can happen. Without money, nothing can happen. And once money is available, you need right set of people to grow your business, which is the management angle. Not sure if you have tracked this. Recently, there was an announcement by Zomato, that is Eternal, where the main person is exiting out of the company, and there is a CEO change which is happening. These things may matter a lot in the practical world, and even share price may react because of these news. So right management is very critical. So fundamentals of businesses, SFM, strategic financial management, is the name. Earlier we used to call the subject. What is SFM? Strategy here. F is financial, and M is management. These are the three clear fundamentals of a business. Simple example, a startup may have a disruptive idea, skilled founders, but without funding, it cannot execute any of that. Without money, nothing can be done. So money is very, very critical if I want to implement some strategy. What is the meaning of a strategy? Strategy is very simple. You want to achieve something. You may prepare a preparation strategy to clear your CA exam. You are going to write your exam maybe in May 26, September 26, Jan 27, May 27, could be 28 also. But you prepare a strategy. What is the strategy going to tell? How are you going to complete all subjects? How are you going to do revision? When are you going to write your mock exam? If the strategy is in place, It will help you in achieving your objective of clearing your CA exam. Your objective is to clear CA exam. Long-term direction and scope to achieve competitive advantage. What is long-term direction? Next 3 years, the strategy tells you how you are going to prepare. Assuming you're writing your exam after 2-3 years, the strategy will tell how are you going to prepare in your to write your exam. Once you are able to decide the strategy, it gives you the direction and ultimately gives you an advantage as compared to the other students. You are at a better position as compared to the other students, and that ultimate objective is very simple. Will I clear my CA exams or not? Ultimate objective is fulfill stakeholder aspiration. What a stakeholder is? Mostly shareholder. Shareholder means he would want share price to increase, he would want huge dividends to be paid. Apart from that, other stakeholders are there. Customers are there. Customers would want a good quality product. Suppliers are there. Suppliers would want regular orders to be given. Ultimate objective, I have to meet the stakeholder. Stakeholder means shareholder, lenders, customers, employees, suppliers, society at large expect CSR activity from many company. There is an expectation that you will do CSR activity. Many corporates expect this to happen. A practical example, Tesla is into the EV cars. Tesla's strategy isn't just selling car. You just sell car doesn't help, because it is trying to build a charging infrastructure and battery technology. Infrastructure has to be developed. In India, EV is under the growth phase as of now. But still, a lot of people want the charging infrastructure to be there. Today, whenever you want petrol, every 1 kilometer or 2 kilometer you may get a fuel station within the city, and outside also you go every 10-15 kilometers you may get a fuel station. So petrol filling is not a problem, but like that charging can't happen. So charging infrastructure has to be developed. There is continuous investments which are happening in that. Once the charging infrastructure develops, maybe a lot of people may migrate to the EV mode. As of now itself, a lot of migration is happening, but later. So my strategy should not say I want to sell cars. Along with cars, build an infrastructure. Then only your customers are going to buy. What are the functions of strategic financial management? See, first before I come to the function, there are 4 important decisions which a CFO takes or finance takes. You may be aware of this. One is called investment. Second is called financing. You would have learnt what were the 3 and 4. Investment, financing, dividend, and working capital. These were the 4 important decisions which a CFO takes. Investment is raising money. Investment is investing the money. Financing is raising money. Third is at the end of the year, you decide whether to pay dividends to your shareholders or not, and manage the working capital. The functions will more or less focus around these 4. What is this for? Search for investment opportunity. Search for investment opportunity. Without investments being there, I cannot generate returns for my shareholders and debt holders. Debt holders also want return. They want interest to be paid. Best profitable opportunity. Best profitable opportunity, that is, identify good opportunities there, make investments. To make the investment, optimal mix of funds. What is optimal mix of funds is, do you raise debt? Do you raise equity? Do you raise in the form of preference? Analysis of results. I analyze the performance of the company. After the analysis, I may decide to pay dividends. I may decide to do certain correction in the company. I may decide to take certain future decision of raising more money, making more investments. All of this are purely functions of the SFM. Okay, as I said, the key decisions are here: financing decision, investment decision, dividend decision. Okay, at inter level we learned working capital. Here they have used the term portfolio decision. Portfolio is mix of various investments which are happening. You, instead of analyzing it on a standalone basis, coffee business and ice cream business are not that good, because coffee may do bad at few times, ice cream may do bad at few times, risk is on the higher side. But when you combine it as a portfolio, maybe both are good. As a portfolio, coffee business and the ice cream business together is a good business. Coffee and ice cream together is a good business. On a standalone basis, I'm not getting that much amount of comfort. But when it is combined together, I'm very happy with the business. So, four important decisions. Financing, you are aware. Financing is debt, equity, and preference mix. You would have learned it as three chapter in CA Inter: cost of capital, capital structure, and leverages. Investment decision we have learnt here also as advanced capital budgeting, and at CA Inter as capital budgeting. Dividend decision was again a chapter. What is dividend decision? Division of earnings between shareholder payment and reinvestment. Portfolio decision, evaluation of investment based on contribution to the aggregate performance. The aggregate performance can be from a return point of view, can also be from a risk point of view, because on a standalone basis some business may not be good. For example, I am an EV manufacturer. What I am doing is I'm installing thousand EV charging station in the entire city. Loss making. That charging infrastructure does not give me any profit, but because I develop that infrastructure, I'm able to sell more cars. So charging infrastructure is good, even it's loss making. Even if it is loss making, it is still preferable because people are now buying more cars. Clear? Any doubts on this? And I'll give you some 2-3 minutes. I want you to read question 1, 2, 3, 4, 5. Till 5, you just do a plain reading. 1, 2, 3, 4, 5. I give you some 2-3 minutes. Page 470. Okay, next comes what are the three different types of strategy. Whatever you are seeing here, I hope you have already seen it at maybe CA Inter. There are three types of strategy. One, strategy for Reliance Industries, that is called corporate strategy. Second, in Reliance Industries, Reliance Geo, which is a subpart of Reliance Industries, they develop a strategy that is called business strategy. And within that, the HR managers, the HR is hiring engineers. So HR develops his own strategy. Three types of strategy. Corporate level is Reliance will decide what type of businesses they want to do. As of now, they are into multiple businesses. Then within Reliance, so many businesses are there. Each of the business will develop his strategy, that is called business unit level strategy. Every business will have multiple functions. What are multiple function? Production function, sales function, R&D function, purchase function, finance function, HR function. Every function will develop their own strategy. That is called functional level strategy. So three layers of strategy is there. One is corporate level, then there is a business level, then there is a functional level. A very simple example: Reliance Industries enter the telecom market, that is the corporate level strategy. Geo deciding pricing strategy for capturing the market share, that is the business level strategy. And HR hiring engineers, the HR is hiring engineers to build the 5G network, that is the functional level strategy. Reliance said, I want to enter into Geo. Moment they said enter into Geo, from the corporate strategy came the business strategy. Geo has developed its strategy to build the market share. When Geo developed the strategy, I informed my HR saying that I am increasing market share. I will need lot of telecom towers to be installed. Network has to be strengthened. So HR is hiring the engineers. From the top. The bottom level strategies will come. What is the function of corporate level strategy? What are the three basic questions it should answer? Corporate level strategy is very simple. It is going to decide which businesses we are going to do. Today, Reliance may not get into an education business, or they have a. I think there is also a wing which talks into education. But there are businesses where they may enter. There are businesses where they may not enter. This is decided at a corporate level strategy. Basically, it is going to focus on these three things: suitability, feasibility, and acceptability. When I say suitability, whatever business I'm going to enter into, is it suitable for me or not? Example, Reliance wants to get into, let's take an example of automobile car manufacturing. If Reliance wants to enter into car manufacturing, is it suitable for them or not from their overall mission point of view or overall vision point of view? Suitability is checked first. With the suitability, is it feasible or not? Car business, randomly anyone can't enter. Reliance does have all the possibility. Maybe in future they enter also, but to enter into, maybe they have to do some tie-ups and other things. Feasibility is there or not. Third is whether my shareholder will agree to that business or not. Acceptability to my shareholder. Suitability, feasibility, and acceptability. These are the three core things which my corporate strategy is going to answer. If something is not suitable, not feasible, not acceptable, don't get into that type of a business. Clear? Any doubts on this? Financial planning and what are the components of financial planning? At my personal end, I keep talking about financial planning because I'm in a wealth management firm. Very simple. We speak to a person. What is financial planning? You come to us. I ask you, what are your inflows? What are your outflows? Inflows is salary and other things which a person gets. What are the outflow? He may have certain regular expenses, certain one-off expenses. Is there any balance money available? How are we going to use those balance money? Are we making investment? Financial planning is how are we going to use the available resources or use the available money. At my home, the financial planner could be my mother. She takes care of she knows where the money is coming from and where the money needs to go. In a corporate, the CFO is going to take care of the financial planning. Financial planning is the backbone of the business planning. Whatever business plans you are putting in, see whether there is a backup available. What is backup? Backup is whether money is available. Without money being there, nothing can be done. Without finance being there, none of the activities can happen in the practical world. CFO plays an extremely important role. He is equally important as the CEO and other people in the practical world. You could be a production manager, you could be a sales manager. They are only bothered about their segment, but the CFO has to take care of everything. So first, what are the resources available? If resources are available, how do you want to manage them and put together? This will help you in achieving your financial goals. Resources plus tools. For example, you have the resources. What is resources? Your salary minus expenses. Every month surplus is 50,000 rupees. What are tools? I say that we will invest 20,000 in mutual funds, 10,000 in gold, 5,000 in silver, another 5,000 in some FD, another 10,000 we will keep it safe. These are the tools I'm using to manage your funds. What will this achieve? It helps me in achieving my objective. What is the objective? I want some money for my child education. After 20 years, I want some money. That the resources plus the tools will give me some 20, 25 lakh, 30 lakh, 40 lakh, 50 lakh, whatever I want. I want some money for my retirement purpose. That money is going to come through the resources plus the tools. The resources plus the tools. Financial resources plus the financial tools will help in achieving your financial goals. Clear? Any doubts on this? Outcomes of the financial planning, that is after you do the financial planning, what can be the outcome? I'll first tell my personal end. Okay, personal end, the outcome will say we are going to invest around 20,000 in mutual fund, 10,000 in this, 5,000 in this, 5,000 in this. You will keep making these investments on a regular basis. We will review our performance at a regular monitoring, and see whether your objectives can be met or not. Sometimes we have advised our clients saying that no, you do not have adequate money available. Either reduce your expense or reduce your goals. Your goals will have to be, somebody will say, I want 1 crore for my kids' education. The money available is not saying that that is possible. We advise clients 1 crore is not feasible for the kind of income you have. Either increase income, reduce expense, or reduce your goal. Reduce your goal. So here financial objectives will be there. Decide at the beginning. For example, ROI of 15%. Personal end, 5 crore needed after 10 years. I need 5 crore after 10 years. Decision making, analyze and decide the course of action. What is course of action? One example, they're saying lease versus buy. I need money regularly, but money is not available in the business. So you may go through lease versus buy. Personal end, I keep talking about the personal end. The personal end, I tell certain people that either reduce your goals or reduce your expenses. That's a decision. Let's take it now. Are you ready to reduce your expenses if feasible? Third, I want to regularly monitor the performance. Financial measure. We do a review. Review can be done through ratios, can be done through cash flow analysis, and this will ultimately tell whether our objectives are going to be met or not. Clear? Any doubts on this? I give you again maybe 2-3 minutes. Question 6, 7, 8, 9. I think 6, 7, 8, 9. Yeah, go through 6, 7, 8, 9. 3 minutes. Okay. Next is interface between financial policy and strategic management. Strategic management is what you learned at inter level. Very simple. Any company, whatever strategy you do, the most important part is money. Money is the starting point of an organization. They use a term called money is the starting point of an organization and technically the end point as well. So starting is money and the end point is also money. You cannot develop any strategy. Zero strategy can be developed without keeping the financial policy in mind. Anything happens in a practical world in any company, any big decision, the CFO will have a role in that. The CFO is going to have a role in that. So whatever strategy you are developing, before that, the starting point is money. It is like this. This is the circle I've given. Money, this, it's a cycle. Start with money, you develop your strategy. Strategy will give you certain money again, and it's a continuous cycle. So financial policy cannot be done in isolation. If your strategy is expansion, then maybe sources of finance have to be thought about. If you're planning to expand, sources of finance come into picture. You need to decide whenever you are expanding, what is the capital structure I decide. Investment decision is where the money is to be used. Fixed assets purpose or working capital purpose. Dividend policy, one, meet the needs of the shareholder. Second, meet the needs of the future growth. You need to balance both. So there is a huge linkage between financial policy and the various other strategies which are being developed. You should write an exam that the starting point is money and the end point is also money, and based on that all other strategies are being evaluated. How financial goals can be balanced vis-a-vis sustainable growth. I'll explain first what is this term and then I explain this. You see here, demarketing campaign, save fuel. You will see many petrol station tell you to save fuel. If you save fuel, will their sales go down or go up? Petrol place. If you reduce the consumption of fuel, will it reduce their sales or increase their sales? Why should a company tell you? I am telling that don't take my classes. Why will I tell that? Don't take my classes. So similarly, the petrol companies, the oil and marketing companies in India, BPCL, HPCL, IOCL, all are telling people to save fuel. Reason is very simple. Sustainability. What is sustainability? Is if everybody consumes fuel a lot, The world may run out of fuel at some stage. The world may run out of fuel at some stage. What is sustainable? Ensuring that it is available for the next generation also. Ensuring that it is available for next generation. Resources are limited. Judicial use is needed for future generation. Demarketing campaign, save fuel. This deviates from the usual what, sales growth strategy, but ensures what, survival. If I keep on selling fuel at a rapid pace, after maybe 30-40 years, petrol may not exist in the world. Petrol may not exist in the world unless we are finding out new sources of petrol. Petrol may not exist. So that is why people are saying, no, no, please don't consume it a lot. You save fuel. You save fuel. Sustainable growth. Consider the financial consequence of sales increase. Sales increase is always not good. Okay. You will, I'm not sure if you, okay, there is this company, Cafe Coffee Day. The Cafe Coffee Day at some point of time was rapidly growing. What is rapidly growing is every 10-15 days, 5 new outlets, 10 new outlets. They were rapidly increasing the outlet. Got into debt trap because they were rapidly increasing outlet. They borrowed lot of money. Outlets were also not performing well. So much money was spent, debt is taken, they got into a debt trap and was almost on the verge of liquidation. Some recovery has happened recently is what I get to know, but very rapid growth. Let's take an example of Hotel Sangeeta. If Hotel Sangeeta starts opening 20 another outlets in Chennai, 40 outlets in Chennai, 60, there is continuously, they are also opening as of now. But if you continuously keep opening 20, 40, 60, 80, 100, business will get tougher. So sales increase is not always very good. It's not always very good. There's a conflict arises if you keep increasing sales. If you keep increasing sales, there's always a conflict. Many a times, it's like very simple. You are running a marathon. If you run in a marathon, there are people who will start running very fast. Very fast, you run 1-2 kilometer over, story is over. After that, you cannot run. You will not be in a position to run beyond that, or your speed will significantly fall down. The people who have done marathon training, if I suddenly go into a marathon, I get excited saying that, okay, marathon, I run for 2 kilometers at a rapid speed and that's all. I break down at that stage. I will not be able to run beyond that. This is what sustainable strategies say. Sustainability is very simple. Keep growing at a rapid pace. Keep growing at a regular pace, not rapid pace, not regular. There are businesses which do a rapid growth also. It depends on whether we are in the introduction stage of the product, or growth stage, maturity stage, decline stage. So the Cafe Coffee Day is a very good example to understand sustainability part. Because they were growing at a rapid pace, most of the outlets became non-profitable. They became non-profitable. What makes an organization financially sustainable? And ICA also talks about sustainable. They have asked what makes an organization financially sustainable. They have also asked what makes an organization sustainable. To me, both were same only, but ICA has two different terms. Financially sustainable is very simple, that whether I will have adequate amount of money, to meet my future growth at my personal end. Income diversity. What is income diversity? I get income from Bharadwaj Institute. I get some income from mutual funds. I get some income from shares. I do some consulting work. I get income from there. So more than one sources of income is there. Kind of comfortable. I'm kind of comfortable if my one income stream goes down. Planning rigor. What is planning rigor is, I do a regular planning for the next 1 year, what I want to do, how much I want to earn, where I want to spend, where I want to invest. All this, I keep saying this in the practical world, that this is, I keep saying for CA students, that you need to prepare a plan for writing your exams. Your exams is happening maybe 3 months down the line, 6 months down the line, 1 year, 1.5 years, 2 years down the line. Many students mindset is we will see later, we will see later, we'll see later, and once it come closer to the exam, you start panicking. If you have a plan done, that plan will ensure that most of you, some of you could be writing exam in 2027 or 2028. You are attending classes now. Reason is maybe you have done a plan and attend the class, or maybe somebody has told that let's better to attend the class earlier. Ideal thing is prepare a plan. The plan will tell first two subjects I'll complete this time, next two subjects I'll complete, final subjects I'll complete, the final two subjects I'll complete very close, and then I will do revision, and then I'll write mock exam. That is the planning which needs to be done. Planning will ensure that I again go back to that marathon exam only. If you had a plan in place, first 5 kilometers slow speed, warm up is done. Next 5 kilometers speed is enhanced. Again 5 kilometers speed is reduced. Again 5 kilometers speed is enhanced. Then maybe I bring down the speed. Then last final 10 kilometers I increase my speed again. So that is your plan in place. Adequate systems need to be in place, because if systems are not there, again, because of lack of internal controls, many organizations have reported lot of frauds and losses. Public image. I give an example of Satyam. How many of you are aware of what happened with Satyam? Any idea what happened with Satyam? Mahindra Satyam. The earlier name was Satyam. What happened there? Any idea? Have you read about it? Anybody? Anybody aware? If you are aware, tell me, else I'll tell you. Okay, Mahindra Satyam, it was a tech company. Before it was acquired by Mahindra, it was managed by promoters. They started to show inflated profits in their books of accounts. Inflated profits by doing window dressing, technical name. What they did, sales did not happen, still book the sales, show debtors, inflated debtors, show cash which does not even exist. They did all of this. Share price continuously went up. Share price continuously went up. Single day, promoter came and admitted to all these things. I think around 85 to 90% fall in wealth. The share price crashed by 85 to 90%. So that image of that Mahindra Satyam was not good. Course correction have happened. Tech Mahindra has acquired it. After that, the image correction is happening as of now. Today also, Reliance has a different image and Tatas have a different image in the practical world. There is a, whatever you said and do, whatever be the scenario, Reliance may be very successful, but their corporate image is not as good as Tata's. Whatever could be the reason, you can debate on it. Adanis are successful, but still the public image, there are again and again some news articles will come, something against them will come. So public image is very critical. Autonomy is giving independence to my various managers. There is a top level manager, there is a mid level manager, there is a lower level manager. Give them autonomy to take decision. Finally is this long-term survival, run for entire 42 kilometers marathon, run for 42 kilometers. Don't break down in between. ICI also has what makes an organization sustainable. I really did not understand much of difference. One is financially sustainable, second is sustainable. To me both were very similar, but still if they ask financially sustainable, you'll have to write those points. Sustainable means you'll have to write these points. To me both are interchangeable, but still be very clear, because if they ask financially sustainable, you will write a different answer, and sustainable you will write a different answer. Sustainable, clear direction is corporate strategy. Prepare a corporate strategy. Context scanning, what is context scanning is, look at the environment or industry and see if there is any opportunity for making an entry into an industry. Example, Reliance found out an opportunity in the telecom sector and entered into the telecom sector. Talent management is recruiting right resources, that is recruiting right people and retaining them. Now I can write this even in financially sustainable. I don't see any big difference. That's why I said no big difference. Infrastructure, infrastructure is availability of resources. Availability of resources. Resources can be men, material, machine, money. All the resources need to be available. Impact leverage. What is impact leverage? Is demonstrating the impact of whatever resources you have utilized. Once you show the impact, further resources will come. Today I want to raise more money, people are not ready to give. Reliance wants to raise money, he will get money because he's already demonstrated the impact, he has been showing the impact of using the resources. Community support is CSR, do CSR for the society. Many organization do CSR activity, they do CSR activity. CSR activity does not contribute to profits, does not contribute to profit, but still you will have to keep doing it. Clear? I'll tell you the question number. Question 9, 10, 11, 12 and 16. Just read them. 9, 10, 11, 12 and 16. I'll give you around 2-3 minutes. Okay. Next part. What is sustainable growth rate? Sustainable growth rate is the rate at which I can grow. The rate at which I can grow without any impact on my survival. What happened in case of cafe coffee days? They grow at a very high rate which could not be managed. This you are aware already. There was a formula for growth rate called ROE into retention ratio, and that is technically my sustainable growth rate. Sustainable growth rate is equal to ROE into retention ratio. ROE into retention ratio. This is a comfortable rate. This is the comfortable rate I can grow. Maximum rate of growth in sales that can be achieved given the profitability, asset utilization, dividend payout, debt ratio. What is debt ratio? Is debt divided by debt plus equity. Here, how much can I grow without borrowing more money? Not without borrowing money, without borrowing more money. What is without borrowing more money? You have your debt equity ratio, maintain the debt equity ratio. Maintain the debt equity ratio. If equity increases by 20%, increase debt also by 20%. The ratio has to be maintained. What Cafe Coffee did? They equity did not increase, debt doubled 3 times, 5 times, 10 times. Then trouble will come. Then trouble is going to come. I have a target capital structure. I want to maintain that target capital structure. I want to maintain the target capital structure. I also want to maintain a target dividend payment ratio. Sustainable growth rate is the rate at which you can grow without borrowing more money. Without borrowing, I'm using the term more money. A variant of this is internal growth rate. Internal growth rate means without borrowing any money, without borrowing any money, without raising equity, without borrowing any money, without raising equity, without raising, max growth achievable only using internal resources. What is internal resources? Retained earnings. Here I can have an increase in debt. I can have an increase in debt. Focus, self-sufficiency, here consistency, both have a target dividend payment ratio. You will have a target dividend payment ratio. Point is very simple. If an organization has to grow, somewhere it has to borrow money. It has to borrow money. There are businesses which don't borrow money also, but somewhere if you want to grow, borrowing money is very critical. Uh, Today, Infosys, TCS, everyone is following internal growth rate concept. What is internal growth rate? They don't borrow money because their debt equity ratio is zero. Their debt equity ratio is zero. They may not borrow money. They in fact don't even have, don't even know where to use the available money. So much profits they are making, they are not able to find the purpose of using that money. So it goes in the form of dividends. So sustainable growth rate is without borrowing more money, and internal growth rate is without borrowing any money, without borrowing any money. Clear? Any doubts in this? Often a conflict can arise if growth objectives are not consistent with the sustainable growth. What is this sustainable growth rate? Says ROE into retention ratio 20%, and you want to grow at 50%. Your sustainable growth rate is saying you can grow only at the rate of 20%. You are suddenly saying I want to grow at the rate of 50%. If you grow 50%, you will see one question when I go to business valuation. Ideally, I should have done it in this chapter, but I do that in business valuation normally. You want to grow at 50%. How will you grow at 50%? By borrowing more money. Because if you want to grow at 50%, all your assets may increase, liabilities may increase little bit. So extra money, where is it going to come? Debt. If you borrow more debt, ultimately it can get into trouble. It can get into trouble. If an enterprise grows too fast, it may run out of cash or become over leveraged. If an individual runs too fast in a marathon, he may run out of energy. He may run out of energy. If it grows too slow, it wastes resources. Growing too slow is also bad. Growing too fast is also not good. So I should ensure that my financial policy and growth speed aligns, and growth speed matches my sustainable growth rate, matches the sustainable growth rate. Anything above sustainable growth rate is leading to trouble. That is going to lead to trouble. Clear? Any doubts on this? One example on sustainable growth rate: total asset 250, total liability 220. What can be the difference between the two? Equity is 30. Sustainable growth rate is ROE into retention ratio. Don't look at the other part of the answer. Okay, this is 30. Net income is PAT. Net income is PAT. 12 by 30 is ROE. ROE is 40%. 12 divided by 30. Net income, which is PAT. PAT divided by the equity. PAT divided, ratio analysis. Dividend paid is 4.5. Payout ratio is 4.5 by PAT. Payout ratios 4.5 by PAT. Can you tell me 4.5 by 12 is how much? 37.5. 62.5 is the retention. 62.5 is the retention. ROE into retention ratio. ROE into retention ratio. I'll repeat again. Total asset. I don't want to spend much time on this. This is ratio analysis understanding. Total asset 250. Total liability 220. Gap is 30. Net income is 12. 12 divided by 30 is 40%. 12 divided by 30 is 40%. ROE into retention, I can grow at 25%. Max sales increase 100 plus another 25% you can do. 100 plus another 20. If you want to make 100 200, then that can lead to trouble. That can lead to trouble because you may have to borrow money and other things have to be done. Clear? Any doubts on the concept here? Any doubts on this? So we are kind of done with the chapter. We saw first sustainable growth rate. This sustainable growth rate is given by a person called Robert C. Higgins. Why I am saying this term, I'll explain in a minute. Then there was a sustainable growth and internal growth rate, conflict part, and there was a November 22 exam question on sustainable growth rate calculation. I will give you around to page 466. Question number 10, case study. Read and answer all the 5 questions. Read and answer all the 5 questions. I give you time. I'm not discussing anything. Okay. You read the case study. If you want to refer the theory notes, refer the theory notes. 5 questions are there. Go through it. We will discuss after 6-7 minutes. After 6-7 minutes, I'll discuss it. September 25 MTP. XYZ Limited, a medium-sized company in the renewable energy sector, is experiencing steady sales growth. Company's management is concerned with about balancing rapid growth with long-term sustainability in the past year. Growth objectives have led to aggressive expansion plan. Aggressive expansion plan. But management now realizes that such growth may not be financially sustainable, which is what I had explained in the theory, saying that it is not sustainable. How to maintain financial health while achieving the objective? Sustainable growth rate. Company now needs to decide that operational financial policy aligned with the growth goals. Must avoid expanding too quickly. Expanding too quickly, this will strain your financial resources. Excessive borrowing. Management must also consider long term implication of the resource consumption, particularly in the renewable energy industry, where sustainability, they're saying if you keep consuming the resources, we may run out of the resources, some story, but renewable shouldn't be a problem. Renewable means you can continuously keep producing it. It needs to focus on building its growth capability alongside the growth strategy, necessary infrastructure and financial planning in place. If you remember, these were the points for financially sustainable. These were the points there, saying that you need to have an infrastructure, you need to have a financial planning in place. Furthermore, the company is aware of the risk of relying too much on external financing and wants to maintain a balance. Concept was introduced by, I really don't like this question, who was the person? Robert Higgins. Sustainable growth rate represents rate at which the company can grow by issuing more equity. No, we don't issue equity. We don't issue equity. Maximum rate of growth without borrowing additional funds. It is right, but it should have been worded little better. What is without borrowing additional funds? Without borrowing additional funds beyond the debt equity ratio. Beyond the debt equity ratio. Growth determined by market demand, rate of growth, all this is of no use. It should have been worded little better. Without borrowing additional funds in excess of the, I can borrow money in line with my debt equity ratio. Was the answer to the third one. If you grow too quickly, what can happen? Liquidity issue. I don't know why they gave question number 4. Somewhere they have talked about the, what are the 2 points they have talked about for growth? Somewhere it is mentioned here. Growth capability along with the growth strategy. Fifth one was a good question. In an inflationary condition, if creditors require that you maintain historical cost debt to equity ratio. What is historical cost debt to equity ratios? I have some values in my books of accounts. Go with those values and maintain the historical cost debt to equity ratio, means whatever was the value in the past, maintain that debt to equity ratio. If inflation increases, whatever assets I buy, the value of the assets will go up. The value of the assets will go up, but I may not be in a position to borrow more debt. For example, I want to buy a machinery worth 10 crores. When you buy a machinery worth 10 crores, historical cost was only 5 crores. So your borrowing could be on the basis of 5 CR, whereas now you need 10 CR. Now you need borrowing. What is borrowing? My debt equity ratio is 1:1. So I'll borrow in 5 crores 1:1, not in 10 crores. So if you borrow less, you have to retain more money. If you have to retain more money, so indirectly, what is going to happen is this money which I'm retaining, ideally should be used for growing the company, but that retention is not used ideally for growing. It is replacing my assets. It is replacing my assets and not giving me that growth momentum. The growth is not going to come in, because whatever money I'm retaining earlier with a low retention, I could have got the growth. So if you are in an inflationary condition and you are not having adequate resources, ultimately growth rate will get impacted. Ultimately growth rate will get impacted in case you are not able to get the resources, See, I need 10 CR, but I do not have the resources. So what I do, instead of expanding my plant capacity by 10%, I expand only by 5%. If you expand by 5%, obviously you cannot grow. You cannot grow. Clear? Any doubts on this? Any doubts on this? I'll see one more case study. We will do this together. In a recent board meeting of N Limited, following financials of N Limited for the year ending 31st March 2025 were presented. Case study 9, equity capital, 10% bond, sundry creditors, bills payable, other current liability, not very critical. Then there is a director A said that the company can maintain a certain growth even though the profit margin remains constant, assets increase proportionately to sales, and it distributes 30% of its net profit. It will not require any external fund. It will not require any external fund. Director B proposed just by maintaining a target capital structure without issuing additional equity, maintaining target dividend payout ratio, more growth can be achieved. Division C though agreed, but is of the view that in the coming year sales will grow. We can go for issue of equity shares, bonds or debenture. 3 points are there. I'll repeat. Director A saying I can maintain a certain growth, though the net profit margin will remain constant. Assets will increase for the sales increase. 30% I will distribute, 70% I'll retain. I don't want any external fund. No external fund means no external equity, no external debt. Director B is saying, no, what you are saying is right. But let us maintain a target capital structure. Target capital. What is target capital structure? Debt to equity ratio. Don't raise any equity, but you can raise debt. How you can raise debt? Because your equity increases because of internal equity, because of the internal equity. Director C is saying, you all are good, but I feel we have to grow by 15% and let's issue equity share also, bonds also, debentures also. Look at the three and tell me what is answer to 1, 2, 3. Options are same. Director A, what is he talking? Director B, what is he talking? And Director C, what is he talking? What is Director A, B and C is talking? Okay, correct. Director A is internal growth. Reason is without borrowing any money. Our sustainable said without borrowing more money, Then question number 2, sustainable growth rate. So this is internal growth rate. This is sustainable growth. Question number 3, there's nothing like an external growth rate. It's called external funding requirement, EFR. I have a question on EFR. I don't know why I've kept it in business valuation, but I've kept it there only. So I'll do that question when I go to business valuation chapter. And this question I'm not doing now. There I will discuss. This got tested in the recent exam. This got tested in the recent exam as a 4-mark question. External fund requirement. And unfortunately, that's unfortunate. CA Inter latest attempt, they ended up asking CA final question for 8 marks. This question, external fund requirement. This question got tested in CA Inter also. Unfortunate, but that's okay. But it got tested there also. Same thing. The concept was external fund requirement. I'll discuss external fund requirement. I have it in my business valuation because I discuss certain things and then I discuss that. So we will discuss it there. We are done with the theory element. We are done with the theory element discussion. One problem is there on EFR. Institute study material in chapter 1 only, but I do that question in chapter on business valuation. We will see that. Any doubts on the chapter? Again, I'll not summarize and all, but I'll tell you the importance only. One question has come from in this chapter every attempt except for the recent attempt. But in recent attempt, they asked the EFR question. They asked the EFR question. How much funding requirements will come? That got tested in exam. So chapter 1 is very critical. Securitization chapter, which we have already done, one theory question has come in all the attempts till now. And chapter startup finance, one question has come in all the attempts. Again and again, I'm repeating, theory is very, very critical because of only one reason. Paper becomes very tough. Theory you will have to handle and then secure marks. Clear? We are done with this. Post break, we'll do the other areas. Okay, till now we are done with three theory chapters. I'm starting with the fourth theory chapter now, which is on an area called risk management. This chapter had some practical area as well as a theory area. The practical portion was very minimal. We had an area called value at risk computation, which was basically telling us how much is the maximum loss an organization can suffer. In the context of that only this chapter is, as the name indicates, in this chapter we are going to learn what are the different risks which are there for a company and how can I manage that risk. So how can I manage this? How can I reduce the risk? Risk as such mean something which can go wrong for an organization. Anything which can go wrong is called as risk. You start for your classes, you run the risk of missing the class if you start little late. So that is the risk which you carry. You are trying to catch a flight, you go little late, you'll say it is risky to go late because you may miss out on catching the flight. Risk basically means what can go wrong, and multiple things can go wrong for a business. So first thing is different types of risks faced by an organization. They have classified into four different categories in the ICI material. Apart from the four also, I can talk about multiple other items. First risk is strategic risk. What is strategic risk is the strategy which I developed itself is wrong. I have developed a strategy, and because I have developed a wrong strategy, either it is a wrong strategy or execution is difficult. So strategic risk is risk where a company's strategy becomes less effective, leading to a struggle in achieving goals caused by technology changes, new competitor, or shift in customer demand. When I was in some 8th standard or 9th standard, at my home we had a camera. With the camera we used to take photos and print the photos. That is was available, which is where a film camera company was making revenue. There was a film camera company, they were making revenue. Today they are non-existent because the technology has changed. Hardly you will see people printing photos. You take photos, but printing of photos is almost negligible except for some special occasion. So that company's strategy became less effective because of shift in customer demand. Because of the shift in customer demand, whatever strategy they were developing or they were using, it became less effective. This is the first main risk. Second, compliance risk. As the name indicates, compliance risk means if you don't comply with any rules and regulation, you are going to suffer huge penalty. So inability or not able to comply with rules and regulation can lead to fines, penalties. Rarely it can even go to imprisonment. All of this you would be aware under different laws which you are reading. Income Tax Act has certain provision, GST has provision, your Legal Companies Act has provision. Like that, so many acts are there. If you don't comply with them, it can lead to trouble, paying fines for breaching data privacy. So there is something called as general data protection rules. So I get customer data, I have to protect that data. If I don't comply with that rules, this example is just for your understanding, this is not there in ICA material. So you need to comply with the rules. If you don't comply with the rules, huge penalties can come. Third is operational risk. What is operational risk? Is people and process. There are two main things which are there in an organization. If for example a customer comes to my shop, he comes and orders a product, what I do as a person is I don't record that sale itself. I don't record that sale itself. That time either my people have failed me Are the processes were inefficient, or both are problematic? Both are problematic. You come to my shop, buy a product, ideally that product should get recorded in the books of accounts, and that money should come to me as a promoter, as a company. It should get accounted. What somebody may do is, because your processes are ineffective, it is not even recorded in the books of accounts. Internal risk, failure to cope, day to day operational problem. This can come from people or process. People or process. Another example is machinery breakdown, halting production line because people did not manage the machine properly, or the processes were not fine. You could see this problem happening. Last one, this is what we are going to focus on: financial risk. This is what is going to be focused in the entire chapter. Financial risk is unexpected changes in financial condition. In financial condition, such as prices change. Very classic example. Yesterday silver went down by around 30+%. This would have changed the financial position of many people. Many people would have got, if they were on the wrong side of the silver buying or selling, they would have got stuck significantly, 30+% in a single day. If they had managed this risk properly, they would not have faced this trouble. Prices, exchange rate. What is exchange rate? Dollar going up or dollar going down. Credit rating. Credit rating is, I give a rating on the company's ability to service debt. When credit rating change, the impact of credit rating will be on the interest rate. Anything changes. I have taken a home loan. If interest rate go up by 2-3%, I'll be under deep trouble. 2-3% interest rate going up, significant problem it can create for me. So four major types of risks are there. Strategic risk. Strategic risk is strategy becoming ineffective. Compliance risk, as the name indicates, not complying with the rules and regulation. Operational risk, people and process related. And financial risk. Now we will focus on what are the various types of financial risk. What is financial risk? Is our change in financial position due to changes in the financial condition, like your interest rates, credit rating, lot of things in that. Various types of financial risk. First type is counterparty risk. What is counterparty risk? I sold product to someone, he did not make the payment. Counterparty is not fulfilling the obligation. Payment is one thing. You told me to manufacture product for you. I did not get advance, unfortunately. After manufacturing, you're saying you don't want the product. I customized a product for you, and ultimately what you're saying, you don't want the product. What will I do with that? Non-honoring of obligation, failure to deliver goods or payment, failure to accept goods, also you can say different things. Political risk. Political risk is, I invested in, let's assume, as of now, in Bangladesh, I have a manufacturing plant. The political scenario is little bad between the two countries. Because of that, my manufacturing facility is suffering. My manufacturing facility, which is in Bangladesh, I am not able to do well. There is a possibility that my entire investment can even get wiped out because of the political risk. Entire investment can get wiped out. Adverse action by the host country. Today, if Bangladesh country says confiscate all the manufacturing plants by Indian company, don't allow them to operate, directly it will have an impact on my financial position. Interest rate risk. Changes in the interest rate. You learn this as a part of a chapter called interest rate risk management. Changes in the interest rate going up, going down, both are trouble. Going up is also bad, going down is also bad. Changes in interest rate affecting asset or liability value, primarily for companies which have lot of interest sensitive asset. Banks very much there. What is interest sensitive asset? If you have lot of fixed deposit or lot of loans taken, you will suffer when interest rates are changing. Currency risk, these two chapters we are yet to do. Interest rate is learnt as part of interest rate risk management. Currency risk we learn as part of forex chapter. So any changes in currency exchange rate, people are going to suffer. A classic example, there are students who do international courses. The fees for the international courses for Indian students is up by around 20%, not because they have increased the fees, because of the exchange rate. Earlier $1,000 means 80,000. Now same $1,000 has gone up by around 15-20%. Pounds same story, euros same story. So currency risk can impact even a small person like us who are dependent on one international transaction. Like that, lot of companies can suffer if they have huge imports and exports. Liquidity risk, a lot of time what will happen is I am in urgent need of money, urgent need of money. Yesterday event, I will again go back. Silver, when it crashed down, in the market we have something called as ETF. We learned about close ended mutual fund. These close ended mutual fund, when the real fall was 20%, the close ended mutual fund even fell by 30-35%, because everybody went ahead and said, no, let me go out, started selling it, started selling the ETF. When supply increased significantly, demand was not there. Price, which should have gone down by 20%, went down by 25-30%. In the ETF market, you see yesterday price went down significantly, then even the real fall. Reason, people panic started happening. Because of the panic, everybody started going and selling it. Inability to meet liability when they become due. Why when they become due? The silver is one example, but I wanted urgent money. Yesterday I wanted urgent money. I will sell at a certain discount. Selling asset at a discount to pay urgent debt. Clear? So these are different types of financial risk. A very small chapter. One question has been continuously coming from this chapter. Recent attempt, question came in normal paper. Also in IBS, a theory question came. So both paper they ended up asking one theoretical question from this chapter. Now this financial risk, again we focus little bit more. What is financial risk? Also the financial risk can be viewed from different perspective. We have understood financial risk refers to unexpected changes in financial condition, which can be prices, exchange rate, credit rating, interest rates. Anything can change. Whenever there is an unexpected change, it is going to impact people. Now the financial risk meaning is different for different people. If I am a shareholder, or a bondholder, for me, financial risk is measured through debt by equity ratio, debt by assets ratio. We have learnt this term, business risk, financial risk. So different people view this differently. First is stakeholder. Stakeholders are worried about gearing. Gearing means debt by equity or debt by assets. This is viewed as a ratio, as an indicator of financial risk, equity. Shareholders view financial gearing as risk. In liquidation, they are the least priority. Even lenders are also worried if you have a very high gearing. Company will be worried if you have an excessive borrowing, or you do an excessive lending to a person who is going to default. Excessive borrowing can lead to your own default. Excessive lending to a person who is going to default can ultimately lead to your default, both the things. One is you borrowing excessively. So here, when I want to view what is the financial risk position of the company from a company point of view, they'll see, are we having excessive borrowing, or are we lending excessive to a person who is likely to default, can force, or lending to defaulters can force liquidation, and insolvency can also happen. Third thing, government also views it. I'll tell you which is not going to happen, but if it happens, see, if ICICI Bank collapses or if SBI Bank collapses, entire Indian market will take a big hit. So failure of a large institution is the problem for the government. It happened Lehman Brothers. When it happened, because of this, there was a huge crisis in that country. So in India, S Bank went through a trouble. Somehow RBI managed it. But if S Bank had collapsed, you would see a huge distrust in the market. What I will say, let the money be there in my home. I don't even want to put money in bank account. Let me keep it at home. I don't want money even in the bank account, or let me buy gold, silver and keep it at home, because there's a distrust even with the large financial institution. Governments would be bothered about these things. Government wouldn't want these things happening, any failure of a big institution. So what is financial risk for the government? If there is any failure of a large or big institution. Any doubts on this? To page 475, go through first three questions. Go through first three questions. Okay, we proceed ahead. Fourth question, you are already aware. What is value at risk? Explain its features and application. We did a problem solving earlier. Why value at risk is coming? Because it's a measure of a risk. It's a measure of risk. VAR can tell me how much loss I can have in the worst case scenario. Z score into SD will give you the percentage loss you are going to suffer. Into the Z score is that multiple we had for 95% and 99%. That multiple into the standard deviation into amount invested will convert into rupees. You want for more number of days, less number of days into number of days square root. Key features, it has a component which is one, there will be a time period. You want it for 10 days, 15 days, 20 days. Second, there will be a confidence level 95 or 99. Third, loss are the amount which is going to be there. It uses standard deviation concepts. Time horizon you can do for 1 day, 1 week, 1 month. Now a classic example again. Yesterday's silver loss. None of the 99% also wouldn't have predicted that much amount of loss. Even 99% confidence interval, because yesterday in single day 30-35% fall has happened. That can't be predicted. That can't be predicted even by the concept of value at risk. Probability, that 95-99 gives a multiple, no, this comes from something called as a Z score probability, normal distribution table, and it can help me in setting limit. What is setting limit? In the bank, I have a person called as front end desk. They are doing trading. What is trading? Buying dollars, selling dollar, buying dollar, selling dollar. I have told him maximum loss you can suffer is 1 million. With this 1 million, I reverse worked and told you can invest 10 million. You can invest 10 million. We did reverse working questions when we were solving problem. So I set the limit. Measure maximum loss. It can help me in measuring the maximum loss. Fix limit. A bank calculates that its daily VAR will be 1 million at 99% confidence. This means there is only a 1% chance the bank will lose more than 1 million in a single day. With this 1 million max loss, I decided the limit to be 10 million or 20 million. Performance benchmark. What is performance benchmark? Is to measure the performance of my trading desk. Are they suffering more loss or less loss? And it is also called as a ALM tool. You will learn this in interest rate risk management chapter. Asset and liability management. You have to manage both. You will learn this when I go to IRRM. So these are the various features and application of value at risk. I'm not spending much time because we have done practical question solving on this area. Various hints indicating counterparty risk and how to manage the same. What is counterparty risk is? I am doing a transaction with, let's assume I am ABC Limited. I plan to acquire XYZ Limited. We entered into a deal, everything. Ultimately, if I've entered into a deal on the last day, you need to give me. Or let's take another example. I purchased silver. I purchased silver when the price was 1 lakh. I made the payment to you, but you are not delivering the silver even after 1 month, 2 month. This is called counterparty risk. Why are you not delivering? Failure to obtain the resources. You don't even have the silver with you. You don't even have the silver with you. How will you deliver it to me? You wanted to act smart. I purchased at 1 lakh. You thought, okay, price will go down. We will buy at 80,000 and give it to this person. But 1 lakh became 2 lakh, 2 lakh became 3 lakh. So you do not have the resources itself. How are you going to give the product to me? Regulatory restrictions by government. If at all government puts in some restriction, maybe a counterparty may help, a counterparty may delay, a counterparty may delay if there is a regulatory restriction which comes from the government side. Hostile action of a foreign government. I was to import the product from some other place. Because of the actions taken by a foreign government, I am not able to deliver it to the other party. This also includes to a larger extent political risk. Political risk. Let down by third party are ultimately insolvency. Insolvency of the third party. How do I manage this? Because the question will ask, what are the various hints indicating counterparty risk and how can you manage it? How can you? Where did we learn counterparty risk? We learned this the first risk in the financial risk. In the financial risk, the first risk was counterparty risk. I think this came in the recent exam. I don't remember, but two questions have come. One in normal, one in the your IBS paper. Due diligence. What is due diligence? I speak to lot of people and check are very simple. Before starting my classes or before joining my classes, you would have checked at least with few people saying that how the classes are going to be. Will he complete full syllabus? Will he complete on time? Some discussion you would have had with your friends or your personal experience will be there. So that is due diligence. Due diligence is before you take up my classes, you did some extra checks. Same thing you have to do before you deal with any person. Diversify. You want to buy 10 kg of silver. Buy from 5 different people 2 kg. Buy from 5 different people 2 kg. So even if one fails, at least 8 kg will come to you. At least 8 kg will come to you. Exposure limits. That is what? With a single person, don't deal beyond a level. With the excessive buying, excessive selling, excessive borrowing, excessive lending with a single person. We used to call, when I work in a rating agency, we used to call this as concentration risk. If you have concentration with, we have customer concentration, geographical concentration. Your entire sales was happening in Bangladesh. From India, you are exporting entirely to only Bangladesh. You are under trouble. Another example. Lot of ready-made garment manufacturers in the practical world were exporting to only one country, USA. They were exporting to USA because of the tariff talks which are there or which is already implemented. Many of them have lost significant business. Many of them, many listed companies prices have crashed significantly because of their exposure or concentration to a single geography. Here we are talking about single customer, counterparty. Single customer, if you overcome it or don't set a limit, you will get under trouble. Rapid action. The moment tariff was announced by US, lot of companies started diversifying to other countries. You could have done this little faster itself. Moment there were starting of talks saying that something is going to happen, rapidly act and try to move to other places, and ultimately if you can get some insurance or guarantee. Many a times when you sell from Indian country to another country, you are exporting some product, you may insist on letter of credit. This letter of credit is a guarantee given by a foreign bank. Company may fail, but bank may not fail. A foreign bank may not fail. Or we used to have something called as we still have ECGC cover, export credit cover. So with that cover, insurance cover, I take care of the counterparty risk. I take care of the counterparty risk through this way. Any doubts in this? Go through question 4 and 5. Okay, in the financial risk, the next risk was your political risk. What is political risk? Is actions which are taken by government which can lead to effect on the financial position of a company. Some of the actions which they can take, which is happening in many Indian states itself, they'll say you have to insist on local labor. In Tamil Nadu, you should have only Tamil Nadu labor. Don't take the labor from other states. These are actions which are being taken by some of the governments. All these are an indication that there is a political risk. There is a political risk. So first I have to identify the political risk, which is like insisting on local labor or any adverse actions which are taken by them. How do I assess them? Refer to political ranking in business magazine. Or I would understand how is the position of that government. Stability check, whether this government will continue or not continue. In India, as of now, the popularity of the current government is fine. But in case you feel a risk that the government can change, it will lead to again different action. Once the government changes, they may reverse certain decision, they may take new decision. Evaluate the economic stability. If the economy is doing well, then the government will not intervene much, will not try to take lot of action. If you are stable company or stable country, those countries will not have major political risk because government may also continue and the policies continue that way. How do I manage the technique? How do I manage this political risk? First, very simple. Don't even go for other countries raw material, other countries labor, or even if you are two things. One, I am an US company. I don't even interfere with other countries people or material for my purchases. That's one way. If I've set up a facility in India, please use local raw material and local labor in India. If you do that, the government may not intervene much. The government may not interfere much if you use local labor. Two things. One is if you are set up a facility in India use local resources. Don't try to import a resource. When I say import a resource, employees from US come and then do the work in India. It can lead to some challenges. Joint venture. Joint venture means partner with local country. If you are having an Indian partner available with you whenever you invest from USA, he will take care of some of the risks which are there. Raise debt within the host country. Raise money here and prior negotiation. What is prior negotiation? Let's assume Microsoft wants to or Amazon wants to invest in India, wants to set up a big office, some manufacturing facility they want to enter into. Prior itself, they go to a state government of India, do a discussion with them saying that we are doing this. We don't want any disturbance for the next 10-20 years. Is your policy okay? No, we are ready to welcome you. Please do it. Please do it. So if that prior negotiation has happened, the political risk goes down little bit. The next one was interest rate risk. Interest rate risk we have been learning at different places. Interest rate risk is, one is what is interest rate risk, second is how do you manage. How do you manage this? Chapter 12, 11 or 12, interest rate risk management. There's a separate chapter to manage this risk. Okay, what is interest rate risk? Variation in interest rate. Variation in interest rate. Why will variation happen? Multiple option reasons are there. Monetary policy, you are very well aware, repo rate, reverse repo rate, this will be changed by the RBI. Government action, if government is deciding to borrow more, borrow less, invest more, invest less, all that can have impact on the interest rate. Economic growth. Economic growth, if you are a growing company or if a growing economy, high demand for money will be there, that will again impact the interest rate. Industrial data, foreign investment and stock market position, these are factors which impact interest rate. How do you manage is not discussed here. You discuss this in another chapter where we have multiple techniques called interest rate options, futures, caps, collars. There are multiple things there, forward rate agreements. All these are techniques to manage the interest rate risk. Similarly, what are the parameters to identify the currency risk? Management of this is in chapter 10 or 9, number I don't remember. There's a separate chapter on foreign exchange. That chapter you'll understand how do you manage, how do you identify is there a currency risk or not. How do I identify? Today many companies are going through this problem of currency risk. Whoever is import dependent, they are gone. Export dependent, happy. Import dependent, gone because of the currency movement which is happening. Government action, government action means through RBI try to influence the exchange rate. You have a theory called interest rate parity theory. You learn this in forex chapter. It's a very, there I spend around half an hour on interest rate parity theory that will impact exchange rate. Purchasing power parity theory, another 20-30 minutes we spent there, that also impacts the exchange rate. And external shock, external shock, India is going through a lot of this problem now. External shock, natural calamity, war, rebellions, change of government, war is happening at some other place, our exchange rate is taking a big hit and India is suffering because of other problems and a lot of issues are going, we are going through. All these are parameters to identify the currency risk. This came in IBS paper. This came in IBS paper in the recent exam for 5 marks. Clear? Any doubts on this? Go through 6, 7, 8. So the chapter is almost over from a theory discussion point of view. I have two case study type of question. I'll discuss them. But broadly, what we learned is there are four major types of risk. One is a strategic risk, which is strategy becoming ineffective. Compliance risk, not complying with rules and regulation, which leads to fines and penalties. Operational risk, process related risk or people related risk. And financial risk, changes in financial condition like prices, exchange rates, all these changes. Then we focused a lot on financial risk, where we learned that the financial risk can be a counterparty risk. How do we assess? How do we manage it? Political risk. How do we assess? How do we manage it? Interest rate risk. How do we assess? Managing part we did not see. Currency risk. How do we identify? There was also something called as a liquidity risk, which is your, if in any case you want some urgent money, what happens? Let's go through question 9. TRC Cables Limited, an Indian company, is in the business of manufacturing electrical cables, data cables, including fiber optics cable. While mainly deals with manufactured cables to other country, it has also established its production facility at some African countries, due to due availability of raw material and cheap labor. Some of the major raw materials such as copper, aluminium and non-ferrous metal are also imported from foreign country. Hence, overall TRC has frequent receipt and expenditure denominated in non-INR currency. So, TRC make use of long-term debt and equity to meet its long-term fund requirement. To finance its operation, it also makes use of short-term financial requirements such as CP, bank credit, term loan from bank. If any surplus cash is left with TRC, it is invested in interest yielding security. Recently, due to stiff competition from its competitor, it has relaxed its policy for granting credit, and to manage receivable, it has formed a separate credit division. Further, to hedge, it has entered into OTC derivative contract. What is OTC derivative contract and all? Not your worry, because you learn this when I go to the futures chapter. Major risks which they are exposed to. I have told you different types of risk. It can be outside that also. Now tell me, what are the risks they are facing? First one is country risk or political risk. Where is the country risk? By putting your facility in African country, any adverse action by the African government can trouble you. What are the other risks? Currency risk, because your receipts and expenditure are in non-INR. To hedge against this, we have done derivative contract, but there's something called as OTC. OTC means over the counter. OTC contracts have a risk called the settlement risk. You will learn this when I go to the other chapter. So let's not worry about that. Settlement risk, let's not worry. What are other points? Interest rate risk, because we are borrowing money. We are borrowing money. Interest rate variation can impact. What else is there? Counterparty risk, because you have relaxed your credit policy. I also see one more risk. I see some of the major raw material are like this. I see technically a commodity risk or a price risk, where this is not discussed. It may be there in the answer, not there. But these commodities are highly volatile in nature. Copper prices can go up, can go down significantly. That can also impact me. Currency risk, non-INR. Commodity risk means prices can change. Interest rate risk, you borrow as well as invest. Counterparty risk, due to relaxation of norms. Okay, liquidity risk I did not discuss. What is liquidity risk? Inability to meet your liability, because you have short term borrowing. If there's an urgent need to close that, you will get into trouble. Political risk, it is also dealing with Africa, dealing with African country, because of which you will have political risk. And there's something called as a settlement risk, which you will understand later. OTC derivative. Next one, go through this and let me know. You imagine the risks which are there. Very simple point. May 25 exam question. What are the risks you have? Visualize and then tell me. You visualize 3-4 points. It will be a 4-mark question. At least 4 points you have to write. May 25 exam question. Tell me, what is the first risk you will face? Political risk, because you are dealing with Chinese imports. Suddenly China puts a stop, you are gone. You are also selling it in American market, where US is already pressurizing us with tariff and other things. So practically happening also. China is restricting export of few products, practically happening. US is also penalizing us for the export which we do there with the tariff. That is first risk. Then what else? Currency risk, which is self-explanatory. Currency risk is 100% there. Then, sorry, country is your political risk. What is the compliance risk you see here? Okay, maybe I don't see that to be a bigger risk, but yes, compliance risk, but I don't see that to be a bigger problem. What else do you see? Interest, we cannot say. Maybe there, may not be there. Counterparty, I'll say. Whenever I deal with anybody, if I'm dealing with anybody, I see a counterparty risk. These are the three which comes to my mind. Okay, counterparty risk. There's a point from a student. Commodity risk can be there. Commodity risk can also be there. Depends on what type of product we are manufacturing. But I do see three mainly. I'm seeing. Fourth, I don't know what is there in the answer. First one is your counterparty. Second one is your political. Third one is your currency. Let's see the answer now. Currency risk, since raw material are imported from China and finished goods sold in the USA, fluctuation in yuan, which is Chinese currency, Indian rupee and US dollar. Political and trade risk, change in trade policy, tariff, political instability in China, India or US. These two we have told. Market risk, okay, this is nothing, that's why I said this is a general point. This has come as a general point. Demand for finished products in the US may fluctuate, affecting sales and profitability. This is a general point which anyone is going to have. Regulatory risk. Okay, as he said, compliance risk. You have to comply with rules and regulations of each country. If you don't comply, that trouble can also come. I felt counterparty may also come. Commodity could have also come if we had known what is the product here. What is the product here? So a straightforward question can come, or a question like this can come. Anything can come. With this, the discussion of this chapter gets over. Only one more important theory chapter is pending, which is your security analysis, which we will see later. Any doubts in this chapter? 4 important theory chapters are done. Any doubts in this? Clear? Good morning, friends. Okay, today we'll first start with chapter 4 theory discussion. Will take around 1 hour of time, and then I go back to what we were doing. Till now, we are done with 4 important theory chapters. Now I'm going to start with chapter 4, and I'll also tell you what you need to do for the balance theory chapter. As I said initially, theory carries around 12 to 16 marks of weightage from exam point of view. Becomes very, very critical in case the paper is tougher or a student is aspiring to score an exemption. For them, theory preparation is very, very critical. As I said, there are 5 important theory chapters. One was your chapter 1, chapter 2, 7, 15. Those 4 are done. I'm now starting with chapter 4, which is on security analysis. The discussion on this chapter is an extension of what we did in the practical segment. We did some question solving. We did some discussion on the practical segment. An extension of that is what you're going to see here. Now, what is security analysis? Security analysis is nothing but deciding whether to buy a share or sell a share. In order to decide this buying or selling, practical world, I can go through 2 approaches. One is called fundamental analysis and second is called technical analysis. Fundamental analysis is what we did in various chapters like security valuation, business valuation, or even in mutual funds you were deciding whether to buy a mutual fund which is performing better, which is not performing better. So fundamental analysis focus is on financial statements, what is the company doing, how is the economy performing. The focus is long-term wealth creation. Example, Warren Buffett bought Coca-Cola because its brand value and the cash flows were undervalued relative to the stock price. The price was something and he felt the brand value of Coca-Cola or the cash flow which is just generating is very high. Somewhere market should give a better valuation. He purchased it. He's a legendary investor. He purchased it and maybe then the share price starts moving up. So this is one approach where I try to find out the intrinsic value of the business, and objective is to very simple: buy undervalued security and sell the overvalued security. Technical analysis is based on psychology, supply and demand. You work with certain charts. With the charts, you understand what is the pattern the chart is going to follow. For example, I see something like this happened in a share, then this happened. Moment this happens, I feel now it will go like this. So let me buy the share at this point. Let me buy the share at this time. This is my pattern analysis. I am expecting the pattern to continue. Once it reaches this, maybe sell it because I feel it may go down. It may go down. Again, it will go up. It will go down. Somewhere a pattern, if you are able to find, you feel the pattern will continue. And because of this, you are trying to buy a share, then sell it. Buy, sell, buy, sell, buy, sell. This is short-term trading gain, and this is long-term wealth creation. For long-term purpose, you can only do fundamental analysis. For an interim period, I can do short-term analysis through technical analysis. A trader buys Tata Motor because it broke a resistance level at 500 with high volume. What is resistance? Is whenever it was touching 500 in the past, it started going down. Again, it touched 500, it went down. Again, it touched 500, it went down. It was coming closer to 500 but not able to go beyond 500. There was a resistance at 500. A trader was tracking this moment. It broke out 500. People felt that it will start going up further. Silver for a very long period could not break down. I think $50 or $47 an ounce was the rate. It was not able to break that for a very long time. Once it broke it, it even went to 100, 115, and now it's from an ounce point of view I'm talking. So once the resistance level is broken, you feel that it will start inching upward, so you buy the share. So these are two ways. Now in that, what is fundamental analysis? Fundamental analysis is, as I've been saying again and again, fundamental analysis is forecast the financial statements of the company, forecast the cash flows of the company, do the valuation based on the cash flow, year, cash flow, PVF, DCF, do a terminal value calculation, follow a Gordon's model, follow a Walters model, follow an FCFE approach, follow a proxy company based valuation model. You are trying to go through some logical data from the financial statements along with something called as EIC. What is EIC? Is economy, industry and company analysis. Economy, industry and company analysis. And based on this, I ultimately decide, should I buy a share or sell a share? Undervalued, buy it; overvalued, sell it. Undervalued, buy it; overvalued, sell it. Focus is very simple. True value by discounting the future cash flow. By discounting the future cash flow, whatever you did in business valuation, whatever you did in security valuation, all that will come into picture. And one example, analyst valued HDFC Bank at 2000 intrinsic value based on its loan growth, because loan as it grows, interest income increases for HDFC Bank, cash flow increases. So based on that, an analyst said 2000 rupees is the value. Many analysts are there in the practical world, research house. For example, ICICI Securities will say HDFC Bank is undervalued, buy it; overvalued, sell it. They will release a research report. Maybe in future you could be working in that research wing also, where they will release this research report which will tell you should buy, sell or moderate stance. So fundamental analysis will say please buy the share of HDFC, buy the share of HDFC because it is currently undervalued in the market. This is fundamental analysis. Fundamental analysis, three things: economy, industry, company. Indian economy was going through tough time, again became good, now kind of neutral or still in a good. But one industry which is struggling at this point of time is information technology. IT industry is struggling at this point of time because of artificial intelligence issues which are coming in. Because of AI, many of the IT companies in India are struggling. So I did first economy analysis, then I went to industry analysis. IT could be struggling, but some company which is very well aware of what is happening in the AI and able to do something on the AI, they may still end up going up. They may still end up going up. So economy, then industry, then comes the company analysis. In this, what is economic analysis? Economic analysis is very simple, trying to predict GDP growth of India, trying to predict the GDP growth of India or the national income of India along with certain other metrics. Main focus is at what rate will India grow? At what rate will India grow? Will India grow at 7%, 8%, 10%, 15%? Obviously, that growth is dependent on various parameters. But first thing is the bigger picture is economy, then the in between picture is industry, and then the picture is on the company side. So is the Indian economy likely to grow or not? First thing, if you have a high GDP growth, certain sectors will do really well during high GDP growth like steel and cement, because GDP growth is depend on various parameter. One of the parameters infrastructure development. So if there is a good infra development, steel sector will do well and your cement sector will do really well. Inflation. inflation may have an impact on the economy, may have an impact on ultimately the various companies. If you have high inflation, maybe auto sector suffer, they are saying, but pharma sector may not still suffer. Pharma sector may still not suffer. Why auto is suffering? Prices are going up everywhere, my incomes are not going up, I do not have that much money, so I can avoid buying a car, but I cannot avoid essential medicines for me. Some medicines I'm taking, I may not avoid medicine, but so technically pharma sector is inflation proof. Inflation, whatever happens, doesn't affect the pharma sector, but may affect the auto sector. Interest rates again will impact. One example of interest rate affecting is, let's take real estate. If interest rates continuously go up, real estate demand will start going down, because most of real estate purchases in India are backed by a home loan. If the interest rates are high, I may avoid taking a home loan. I may avoid taking a home loan. So another factor which matters is interest rate. Monsoon, major part of the demand, there is a still, sorry, major part of the demand comes from urban areas, but still rural has a significant population, and a significant part of India's demand is going to come from rural areas. Rural will do well in case you have good monsoon, because agriculture dependency is there in rural. So if you have good monsoon, tractor sales may go up, FMCG sales may go up because of higher rural income, So what is economic analysis is trying to predict how is the Indian economy going to perform. Is it only on the GDP growth? No, GDP, inflation, interest rate, monsoon. Is it the only this? No. You can add up unemployment rates, you can add up poverty rates, you can add up any macro factor. In economics, you have learned macro factors and micro factors. Any macro factor which is affecting India as a whole can be considered under this category. Now, what can I do for economic analysis? What is economic analysis? How do I know whether India will grow at 7%, 8%, 9%? Many RBI comes out with a news saying that India will grow at 7.5%. I used to work in CRISIL Limited. I was part of the credit rating wing, but we had a research wing which always used to come out with at what rate India will grow. They used to give data points on India will grow at 7%, 7.5%, 8%. How do I arrive at that number? See, normally when you do a company analysis, you try to forecast the financial statement of one company. That itself becomes challenging. Now we have to forecast how India is going to perform as a whole, at what rate will it grow. One approach people follow is anticipatory survey. I take a survey in different industries, understand from Maruti Suzuki and some big companies in auto sector. I try to understand what is the likely auto performance. From IT sector, some bigger companies, likely see what is the performance. So one example is RBI does something called as consumer confidence survey. This will give me an idea whether consumers are likely to spend more or less in the next year. If they are likely to spend more, there is a possibility that our economy will grow bigger, will keep growing bigger. Second, barometer or indicator approach. This can end up coming in exam. Barometer or indicator approach, where they talk about three types of indicator. One is called leading indicator. What is leading indicator? Is Indian economy will grow in the next quarter, but before that, in the earlier quarter, you may see Sensex going up. In quarter one. When will Indian economy grow? Quarter two. Leading means it is happening before the real growth happens. Growth, degrowth. It can be either ways. Growth or degrowth. Leading indicators will tell what will happen in future. Building permits. If lot of permits are getting issued or lot of approvals are being given, it is an indication that in the next quarter, real estate growth will be very high. Real estate growth will be very high. Coincidental means as it happens, you see the performance. GDP is growing and GDP numbers are coming out at the same time. GDP numbers and GDP growth. You say GDP is growing at 8% and numbers is getting released at the same time. So looking at the GDP number, I will say Indian economy is doing well. Looking at Sensex, I will tell Indian economy is likely to do well. Likely to do well is next quarter it will do well. I tell now. GDP numbers have come now and now you are saying Indian economy is doing well. This is future. This is present. IIP in India we have something called as industrial production which is measured in every sector. Every sector we come out with IIP numbers, index of industrial production, that will tell what is happening today. Lagging means past issue. Unemployment rate is going up now. The reason is it is going up, the effect has already come in. Indian economy started struggling. One sector, IT sector is struggling. Unemployment will start happening in the next quarter. Unemployment will start happening. Our layoffs will start happening. Not past, not future prediction. Layoffs are happening means it is not future struggle. It is the past struggle. The struggle has already happened in the past. So leading, future, coincidental, present, lagging is past. Lagging indicator, unemployment rates going up. Corporate profits are going down. Why did it go down? Last quarter struggle. Last quarter was the struggle, not the future struggle. So these three indicators can tell you where is the Indian economy likely to move. Where is the Indian economy likely to move can be identified through which approach? Barometer or indicator approach. Third one is economic model building approach. Now very simple. I'll quickly tell you this way. An economist predicts India's GDP next year. Next year I'm predicting by doing what? Projecting household consumption. Projecting the household consumption based on salary hike, government infra spending based on the budget. Budget got announced by India some time back. Private investment. I try to predict each of this, add up all of that together and say what India is going to do. Add up all this together and say what India is likely to do. Estimate demand based on inflation. Forecast various component, consumption, investment, government spending, exports, and finally arrive at a forecasted GNP. What is economic analysis is very simple. Tell me ultimately, will India grow at 7, 7.5, 8, 8.5, 9, 9.5? What rate will India likely to grow? Any doubts on this? To page 82, read question 1 to 4. Please read it once. Question 1 to 4, page 482. I'll give you around 2-3 minutes. Okay, the second segment of fundamental analysis is industry analysis. Today, certain industries will do well. Some industries may not do well. What are the factors affecting them? First is product life cycle. What is product life cycle is? You would have learned something called as introduction, growth, maturity, decline. Good examples are there that will give you clarity. Growth, EV sector, electronic vehicle sector, it's a growing sector. So if you are in the EV sector, you would continue to grow. FMCG is your bigger companies which are there, whatever products you take. So all these products are having stable growth. The various companies like HUL and others are in FMCG. Low profit, decline, landlines are almost non-existent now. Still, you could be a player who's manufacturing landline phones. In that case, your company will struggle. Your company is going to struggle because demand is not going to be there for landline phones. Demand supply gap. In case there is any demand supply gap, more demand is there, lesser supply is there, you will enjoy, and vice versa, excess supply lowers the prices. Excess supply lowers the prices. Example, perfect example is telecom. In the telecom sector, once Geo came in, they came in, competition got increased, and because of which lot of rates came down. Now the reverse is happening because players are not there in the market. Reverse is also happening. So it depends on what is the demand supply scenario. Barriers to entry. If there are any big barriers to entry, for example, I want to open a small restaurant. No major barriers to entry. I want to develop an airport. I cannot develop. I cannot develop an airport. High entry barrier in airport infrastructure. Developing an airport needs lot of money, lot of resources. I don't think I can enter, or most of the companies in India will enter that sector. Whereas restaurant business, anyone can enter. No major entry barrier. External factor, government attitude. Government will support certain industry and will restrict certain industry. Example, tobacco. Tobacco is an industry which government is going to try to cut it down. It will continuously cut it down. Whereas certain industries it will support. It will support PLIs, production linked incentive scheme they give to make people produce more. Competition. Competition, again I go back to telecom sector only now. Monopoly will command premium, though we don't have a monopoly, but we have almost a duopoly. We have a duopoly which is leading to price increase. Cost structure. Certain industries will have high fixed cost and certain industries will have high variable cost. If you have high fixed cost, there's a problem in that industry. Example, airline. Airline has a high fixed cost structure. Many companies in the airline sector could not sustain. You can take example of Kingfisher, you can take example of other companies which started, went out, and many are still not profitable. We are almost at a monopoly kind of a situation in the airline sector because companies are not able to survive. Technology. Because of tech development, certain industries are almost non-existent now. 20-25 years back, at my home we used to have a camera. We used to take a photo, then take a print of the photo. Now that industry is almost non-existent. There are the Kodak which was selling that films, now no business for them. Technically you don't have any business. DVD rental. I have rented out DVD. I have taken DVD on rent, watched a movie. All that happened at some point of time. Now that industry is non-existent. You can't have such industry at this point of time. So technology development can also affect. What are the techniques for industry analysis? First is regression analysis. What is regression analysis? Let's assume a regression equation is like this. Y is equal to A plus Bx. Now Y is growth. Growth in pharma sector. Growth in pharma sector is equal to 2% plus 2% plus 2 into GDP growth. If at all there is a link, 2 into GDP growth. If GDP is growing by 10%, pharma will grow as 2% plus 2 into 10%. This is what regression is trying to say. If IIP grows at 5%, CV sales will grow at 10%. CV sales will grow at. Regression tries to find link between. Hotels industry will grow at 2 plus 4 into per capita growth. If per capita incomes of people are growing at 5%, the tourism sector may grow at 2 plus 4 into this. Degrows, it can degrow significantly. You are trying to establish a link. Input output analysis. What is input output analysis? It tracks the flow of goods or services through the entire economy. If some sector is growing, for example, infrastructure spending is increasing, infrastructure spending is increasing, that would mean increased demand for cement, increased demand for steel. All these are, steel demand is going up, steel demand is going up. It can indirectly indicate that, infrastructure is going to have a huge boost. Infrastructure will have a huge boost. It can be either ways. So if I feel one sector is growing, there could be a link with another sector and try to, for example, IT sector, India is struggling in the IT sector. As news keeps coming out, IT index of India went down by 15%. When one single day IT index went down by 5%, same day real estate index also went down. Is there any link between IT and real estate? Any link between IT and real estate? 100% link is there. Most of the IT purchase, most of the real estate purchases in India are expected to be done by high earners, and these high earners are from the IT sector. These high earners are from the IT sector. So if there is a layoff happening in the industry, layoffs happen, these high earners are not there, who will buy the house? Who are going to buy the house? So there is a link between IT sector and the real estate sector. And if IT is not doing well, companies are not going to open offices. Offices are not open, commercial real estate goes down. Today, most of the Indian IT companies in Chennai are in the outskirts, and outskirts growth happened because of what? You see many projects coming up in the outskirts, your OMR, ECR, all that, you see a rapid growth which had happened. One major factor is TCS office. One major factor is Infosys office. One major factor is Wipro's office. One major factor is CTS office. All these led to many millionaires. And what they did, they ended up buying. IT goes down, real estate will go down. Auto can also go down. Auto can also go down. That is the linkage. That is the linkage we are trying to find. Next comes the company analysis. This I will not discuss much, because this we have discussed significantly when we did something called as your normal analysis. Net worth analysis, book value analysis. You are aware of what is net worth, what is book value. So depending on the book value of a company, maybe the price of the share is estimated. Sources and uses of funds, where the funds is coming from, where the funds is going out. I do an analysis to see how is the company likely to perform. Time series analysis, cross-sectional analysis. What is cross-sectional analysis? Compare TCS with Infosys. What is time series analysis? Compare TCS 2025 with TCS 2024, with TCS 2023, with TCS 2022 to understand how is the company performing. Company performance. Size and ranking. How is the size of the company as a proportion of the overall industry, or how is the company performing in relation to the industry? Growth record, financial analysis, competitive advantage, quality of management. Today also we believe Tatas have a different quality, Reliance has a different quality. One is the performance, second is the integrity angle. Corporate governance, yeah, as I said, the integrity angle will come in corporate governance, regulation, labor availability, stock holding, marketability. All these factors will affect the price of the share, Now, is it only these factors? These are company level. On top of it, industry level. On top of it, economy level. On top of it, economy level. Clear? Any doubts on this? What are the techniques I will do in company analysis? Correlation and regression analysis. Regression I've already told you. Correlation is, again, I am going to find out, is there any real linkage between factor 1 and factor 2? Example, forecasting the sales growth. Forecasting the sales growth based on advertising spend. Based on advertising spend. If advertising spend is going up in one quarter, I forecast next quarter company will grow at a very healthy rate. Next quarter, it will grow at a very healthy rate, because there is a positive correlation between ad spend and your sales growth. This is my understanding. Trend analysis. What is trend analysis? Is looking at the past data and forecasting the future number. Decision tree analysis. decision tree analysis, doing sequential analysis, understanding phase 1. If you get a success, value is 100 cr. If you get a failure, value is 0. After that you get further success, further failure, further success, further failure, and try to do a reverse valuation. Try to do a reverse valuation. Any doubts on this? All this part is part of your fundamental analysis. So whatever I discussed now is part of fundamental analysis. I'll give you again 3-4 minutes. 5, 6, 7, 8. Go through 5, 6, 7, 8. Okay. Now I move to the next part, which is technical analysis. Fundamental analysis focuses on financial statements, industry, and the economy. Technical analysis does only one thing. It looks at the price graph of the past, demand and supply data. What is demand and supply? Is volume, volumes of sales, volumes of buying and selling which is happening, and based on that it will give a signal whether to buy or sell. Method of share price prediction based on study of price graph or chart, that price trends are repetitive. Price trends are repetitive. For example, if something like this happens, comes down this much, again goes up this much, again comes down this much, goes up. If this is the pattern I find, I feel this will continue. Buy at this, sell at this place. Exactly predicting is difficult. Again buy, again sell, again buy, again sell. Market value depends on supply and demand. There is nothing else. It is only dependent on supply and demand according to technical analysis. Okay. Supply are governed by rational and irrational factor. What is rational is logical thinking. What is irrational is COVID came in. COVID came in. At that time, Indian index went down by 10%, and not, I think, around 10%. Many companies fell down by around 20-25%. Next day again fall happened. That is because of irrational thinking. Irrational thinking is even after 25% fall, you still feel it will go down, it will go down, it will go down, it will go down because of the psychology. Everyone is thinking, no, no, now lot of uncertainty is there. I cannot leave this. Silver prices were going up continuously, and it went on going up. Irrational buying. Irrational buying. People were least bothered whether it will reverse or not. They were only thinking it will only go up. It will only go up. Stock prices generally move in trend. Generally move in trend. Relies on chart analysis. I only focus on charts. I don't want to focus on financial statement. If technical analysis is what is going to work, and you are part of an equity research team, entire AFM, whatever you learnt is of no use. It is technically of no use at all, because you are not going to look at financial statement, you are not going to look at economy analysis, you are not going to look at industry analysis. Your only focus is what? Price trend. A technical analyst buys Adani Enterprises not because of debt to equity ratio, but because the stock price broke out a 3-month resistance level. It broke out a 3-month resistance level. It broke that resistance level. Resistance means it was not going above that. Resistance level is broken. Buy it, because it will now move up. According to this, market discounts everything. What is market discounts everything is whatever analysis you are trying to do, saying that economy will grow, industry will grow, company will grow, is known to everyone. Everyone knows that. Price already considers the data. Most of the time in the practical world, good quarterly results are going to come. Two things can happen. One, people predict it and start buying it before itself. That is one element. Second, there is some element of insider trading which can also happen, but most of the time the share price up will happen before and the results will come later, and bad results are going to come before that itself. Fall can happen. That is called market discounts everything. Price moves in trend. It moves in trend and the trend will continue. History tends to repeat itself. These are the three principles. Market discounts everything, price moves in trend, and the trend is going to repeat itself. The trend is going to repeat itself is what technical analysis is trying to see. There are 3-4 theories there in this. One is called Dow theory. This is based on first two indexes. One is called Dow Jones Industrial Average and Dow Jones Transportation Average. Dow Jones Industrial Average and Dow Jones Transportation Average. There are three types of movement here. One is called primary movement, second is called secondary movement, and third is called daily fluctuation. This is a very important theory, can come in exam. There are three types of movement which will happen in the stock market. Now, what is three type of movement? This is the Indian market. I feel Indian market will have this. This is the primary movement. This is the primary movement is it will go up. What is secondary movement is? Goes up, reverses. Secondary is fluctuation, reverse. Again goes up, again reverses, again reverses, again goes up, again reverses. Long term trend is it is going up. Long term trend it is going up. Main trend last correction opposite to primary. Opposite to primary. It has to go up. It has to go up. So long bull run 2009 to 2020. Secondary sharp crash happened because of COVID. Did it stop there? No. After 2020, COVID crash happened. Still went up only. Jan, Feb up, March down. April, May, June up, July down. Corrections will happen. And daily fluctuation, random up and down. Daily up will happen, down will happen, up will happen, down will happen. That is of no use. This is random noise. So either the primary movement is successively you are getting higher highs. What is successively higher high? This is the high. Next high is higher than the earlier high. Next high is higher than the earlier high. Next high is higher than the earlier high. This is a bull market. Successive higher highs. Is a bull market. What is going to happen? Primary movement will be there. Secondary is also going to be there. And daily fluctuation will be there. Opposite is this is the trend. Bear market. Goes down, reverses. Goes down further, reverses. Goes down further, reverses. Low. Successive lower low. Successive higher high. Successive lower low. Successive higher high. Successive lower low. Bear market is coming. In this, there are three phases in the bull market, or you can say three phases of bear market also. 3 years back, any marriage I used to go or any social gathering, everyone was talking about stock market. Everyone was talking only about buying share, selling share, because everyone thought market is really up. It will keep going up. Today, nobody talks about the stock market. Whenever I go today, nobody talks to me about the stock market, because today we are in phase 1. Bull market phase 1. Phase 1 is today nobody wants to buy shares. Some 6 months, 12 months back, nobody was talking about gold. That was phase 1. Everybody started talking about gold. Phase 2. And now somebody who doesn't even understand gold or stock market, they entered at silver at 4 lakh rupees. They entered into silver at 4 lakh rupee. Phase 3, speculation, huge speculation. So phase 1, you don't even see market going up. That time, the smart people will enter into the market. This is the phase where news is bad. Prices are low. I personally feel we are at the phase 1 of the bull market. Phase 2, earnings start improve. Trend is coming up. Gold prices started going up. Silver prices started going up. People got excited. After it went up, participation is increasing. Further goes up. Speculation peak. Smart money from silver. Lot of people moved out to stock market. That is the smart movement. So phase 1 is there. Phase 2 is there. Phase 3 is there. Phase 1. Accumulation, April 2020. What is April 2020? It's COVID time. People accumulated. Participation. People saw recovery happening, started participating in the stock market. Distribution, late 2021, 2022, even 2023 it went on. After that, no major returns from stock market. Lot of people enter at the third phase. Lot of people enter at the third phase. Elliott wave theory. This is another theory which is almost similar. There are 3 or 5 waves in the direction of basic movement. 3 or 5 waves is basic movement is up. So up 1, reversal 2, again up 3, reversal 4, up 5, reversal up down, up down. There is a reversal which is going to happen. According to this theory, there will be 3 or 5 waves, 3 or 5 times up will happen, reversal will also happen. With 8 waves, cycle is over, a fresh cycle will start. A fresh cycle will start. Elliott wave theory said this. He said that there are going to be impulsive pattern, 3 or 5 waves in the direction of basic movement. Direction of basic movement is either it's a bull market or a bear market. Reversal is corrective patterns, and once 8 times this happens, maybe the story ends. A bull market can now become a bear market can now become a bull market, or another bull market can start. This is what Elliott wave theory said. Random walk theory. This is very simple. He has said stock prices can never be predicted. I toss a coin. Nobody can say whether it is going to be heads or whether it is going to be tail. It is a random thing. Stock prices can never be predicted because there are statistical up and down, not a result of underlying factor. Successive peaks and troughs are unconnected. Efficient market. What is efficient market? Market is highly efficient. I had talked about something called as efficient market earlier when I did that question solving. I'll also be talking again. Efficient market means people are aware of information, and because you are aware of the information, right action will be taken. Price movements are as random as a roulette wheel. In a roulette, any number can come. 1 can come, 2 can come, 3 can come, 4 can come. So any day price can go up, any day price can go down. A blindfolded monkey throwing darts at a newspaper financial pages could select a portfolio that could just as well perform well as compared to one selected by an expert. I randomly select 5 stock from Nifty, an expert selects 5 stock. My performance and the performance of that person, random selection by anybody can perform as like what an expert is predicting. So there are 3 theories. One is a random walk theory, Elliott wave theory, and a Doe theory. Go through 8, 9, 10, 11, 12. 2 minutes for you. Okay, next is what are the different type of charts you may prepare to find out the price pattern. All of these are going to be very technical in nature, but still I'll discuss it. The first type of a chart people will prepare is a line chart, which is like this. It will connect the prices of every day. Just the prices are connected in this chart. With the line chart, I may able to see a trend, and based on the trend, I may able to take a decision. Second is a bar chart, which is similar to a line chart, but it has multiple data. One is, this is single day data. Okay, in this is the opening price. There is a highest price, there is a lowest price. So highest price is also there. If for example, if something like is there, this is the highest price of the day, this is the lowest price of the day. Highest price of the day and the lowest price of the day. There is a opening price here, closing here, or there's a opening this side, closing this side. Open at one place, close at one place, high is there, low is there, all are there in the chart, all are there in the chart. Every day 4 data points you have to note down: opening price, closing price, highest price, lowest price, all the 4 will come in the chart. Candlestick chart, this is used by many people in the practical world. Again, I'm being very honest, I have never interpreted all these charts and I also still don't understand many of them. So candlestick chart is going to disclose this information. The bar chart displays stock opening, closing, high and low. Candlestick is trying, color of the candlestick is trying to indicate the trend, it will come with a color. A black candlestick indicates a lower closing price, black candlestick indicates a lower closing price. White candlestick indicates a higher one. A doji indicates no change or near no change. Practical world, I have seen people doing a candlestick chart, not for the entire day. For every minute they look at a candlestick. For every minute they look at a candlestick and say that, okay, candlestick is showing something. Maybe it will go up. Buy at 2-1. Sell it at 2-2. Sell it at 2-2. At 2-1 you buy it. At 2-2 you sell it. It's a very, very tricky scenario to be in technical analysis because you're trying to look at minute trends and then take a decision. Point and figure chart is going to plot the prices, the prices are plot as X and O. Point and figure chart, they are used to detect reversal in the trend. Again, as I say, most of the charts you may not understand unless you are a technical expert. Here you are going to again look at the price data, put the price data in terms of this. Every day you look at the price data, right? XO, and there is some reversal technique they have. Again, not an expert this side, so I'm not getting much into it, but this is another type of a chart which you may prepare. All the purposes is to find out, is there a trend and a reversal of trend. Market indicators we have already discussed when we solved question. Breadth index is advance to decline, net advances divided by number of shares traded, net advances divided by number of shares traded. We had a separate concept itself for this. So for breadth index we had a separate concept. If index is up by 80%, but most of the stocks are falling, it is a technical weakness. Volume, what does volume says? Price is going up, volumes are also going up. Price is going up, volumes are also going up, which means many people are trying to buy it. The trend is likely to continue. Price is going up, but volumes are down that day. Maybe reversal is going to happen next day. Prices are going up, volumes are going up, trend likely to continue. Price is going down, volumes are going down. Prices going down, volumes are going up here also. Price is going down and volumes are going up. Price is going down, but many people are trading. Again, the reversal may happen. So price rise with the volume rise is a bullish market. Price fall with the volumes rise is again a bearish market. Volumes going down, price other way round, there could be a reversal which is going to happen. Confidence index, again we saw as part of the theory discussion, ratio of high grade bond to the low grade bond. It is going to precede the rising market and precede the falling market. Support and resistance level. Now this is the price trend, okay? This is the resistance. Above this it is not going. Above this the price is not going. Every time it comes closer to it, suddenly starts falling. Why? Because there are a lot of people who have decided, moment it touches 50, we will sell this share. Moment it touches 50. So when it comes closer to 50, lot of people start selling it. So there is a resistance. At 50. Moment it touches 20, lot of people start buying it. So there is a support level, there is a resistance level. What is the use of this? Stock touches 100 three times but fails to cross 100. Any day it crosses 100, be mentally prepared. It can even go to 150. It can go to 150. Moment the resistance is broken. Moment the resistance is broken, stock can go up significantly. Moment support is fallen. If you have gone below the support level, be mentally prepared that it can go down drastically. It can go down drastically. Price pattern, tools to interpret the trend. Tools to interpret the trend. I never thought ICA will ask price pattern question. Jan 26, there was a question from price pattern. I didn't expect them to do it, but they ended up asking it. I'll discuss it again. One is called channel. This, what does it say? Price is going like this, price is going down, price is going up, price is going down, price is going up. If you are able to find a trend like this, if you are able to find a trend like this, the successive highs are higher than the earlier highs. It is an upward sloping. Price is likely to go up, please buy it. Price is likely to go up, please buy it. A series of uniformly changing tops and bottom giving rise to a channel formation. A downward sloping channel means this is a downward sloping channel. This is a downward sloping channel. A downward sloping channel, declining prices, upward sloping channel, going up. Looking at the trend, you are deciding whether to buy the share or not. Wedge. A wedge is formed when the tops and bottom change in opposite direction. What is change in opposite direction? Top is there, top is going down, top is going down, bottom, successive bottom is going up, top is going down. Look at the difference. This successive tops are up, successive bottoms are also up. Tops is up, bottoms is also up. Successive high is higher than the earlier high. Successive low is higher than the earlier low. Successive high is higher than the earlier high, and low is also higher than the earlier low. Upward sloping channel, downward sloping. What is wedge? You reach this 52-week high. Next high is going to be lower than the earlier high. Next high is going to be lower than the earlier high. Next high is going to be lower than the earlier high. Last bottom. Next bottom will be, the next bottom is continuously going up. Next top is continuously going down. At some stage, both become very close to each other. That is called wedge. That is called wedge. Now, technically remembering all this can be very, very challenging, but I will discuss the chart for you. Heads and shoulder, this is the pattern. The pattern is, this is technically a head and shoulder. Very simple way. This is the technical head and shoulder. There is a shoulder, there is a head pattern, and there is again a shoulder pattern. Head and shoulder pattern means there is a head, there is a shoulder, and this pattern will keep reversing. You see here, you go up, you go down, again go up, again go down. If you are able to find this, a large lump for head, in the middle of two smaller hump shoulder, if you are able to find a pattern in this, triangular or coil formation presents a pattern of uncertainty and is difficult to predict which way the price will go. Practical world, whenever I have looked at a chart, for me every chart is like this only. I've never been able to find out which side the price will move with the chart. There are a lot of technical analysts there. It's a very big market. Technical analyst is a very, very big market for the person to earn, not for you. You become a student of technical analysis, you will only lose money. Because you are going to fight against machines. Machines does algo trading. They do algo trading. Obviously, you cannot compete against all of them. Flags and pennants form. This form signifies a phase after which the previous price trend is likely to continue. Again, as I've said, I am not a big expert in this. The trend is like this: it goes up, reverses, again goes up, reverses, again goes up, reverses, reverses, goes up. This is the pattern. Now, personally, I did not find any big difference between this and maybe something like this also. I am technically trying to understand different things, and I have not been able to exactly find out a difference between many of these items. Double top form is M. 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 Double top form is M. There's a top, goes down, again a top. Double top is M. M. And double bottom is W. Double bottom is W. You can just write it. Double top is M, letter M, and double bottom is letter W. Letter W. There is a bottom reached, goes up, and again a bottom reached. Again a bottom reached. Gap. What is gap? Is gap up and gap down. What is gap up and gap down? Is it closes at some level. Next day opening closes at 100, but next day opens at 105. That is called gap up opening. And for example, Monday, there is a big expectation that Nifty may have a gap up opening as of now because of whatever happened in USA, the tariffs getting removed. There is a possibility of a gap up opening is what people are expecting. Gap up opening means market will open at higher level as compared to the previous close. Gap down opening is opens at a lower level as compared to the previous one. You may not understand much of this, but still I give you time to go through 13 to 16. Go through 13 to 16. I give you around 2-3 minutes. Okay, something which came in exam. A technical analyst at a portfolio management firm is tracking the stock price movement of 5 different companies. Analyst has decided the observed chart pattern as follows. ICI said to come out with the answer, one which is easy to interpret. Scenario 5, read and you look at your notebook and tell which one is this. Scenario 5 is easy to do. It is a wedge where the price highs are consistently falling and price lows are consistently rising opposite. This will come under the category of wedge. Scenario 4. There was one scenario where it says there is uncertainty. I'm not able to find any trend. That will be the answer. I don't even remember what is that. But where you're not able to find the trend, that is what is going to be the answer here. Like this, they ended up asking 5 scenarios. Whether you'll be in a position to manage this even after my class, I have my own doubt. I have my own doubt on this type of a question. Comes in exam, because I know what I'm delivering, because if I'm an expert in it, I can deliver it really well. Somewhere I feel I am not doing justice to this area itself. I never used to teach this technical analysis part because I myself not very comfortable. Unless I am very comfortable in teaching it, I can give you clarity. So this question, if it comes in exam or something like this comes in exam, can become challenge. But okay, let us be aware of various points and then somehow face it in exam. Okay, next part is moving average analysis. We learnt about simple moving average, exponential moving average, where you look at the data. Now, what is the purpose of doing this is, with the moving average, I'll be able to decide a buy signal and a sell signal. Very simple logic is, if the moving average is going up, it is likely that price will go up. If the moving average is going up, what moving average? You can take exponential moving average, you can take 50-day moving average, 200-day moving average. Normally people prefer 50 and 200-day moving average. With the trend on 200-day moving average, if the moving average is going up, it's a bull signal, and if the moving average is going down. If the moving average is going down, it is technically a bear signal. It is technically a bear signal. This is the most important point. Moving average going up, moving average going down, moving average going up, moving average go down. Price drops and then starts rebounding. It comes closer to moving average. It will cross the moving average. Objective is ultimately, are we going to see a increase in price or a decrease in price? Increase in price or a decrease in price? If the moving average is going up, you are likely to see a continuous moving up. You are likely to see a continuous moving up. Moving down, you are likely to see a moving down of the prices. This is the broad point. Apart from that, they are saying price drops, rebounds, price will rebound means it has reversed, the reversal will continue. Price falls, price has started falling, but moving average is a flat line, but price is still falling. Maybe it will continue to fall further. Moving average is a flat line, price is falling, it will continue to fall. Moving average is a flat line, price is rising, it will continue to rise. It will continue to rise. Main indicator, increasing moving average, decreasing moving average. Apart from that, there are other points. Arguments in favor and against the technical analysis. Many people, this has come 2-3 times in exam. Favor means who are supporting this. Who support? Trends happen and hence the trends will continue. Hence the trend will continue because trend is dependent on human behavior. What is human behavior? Moment silver touched 3 lakh. Lot of people said, let us go and sell it. It came down to 250. Human behavior said, let us buy it. Touch 3 lakh, sell it. Touch 2 lakh 50, buy it. Touch 3 lakh, sell it. Touch 2 lakh 50, buy it. Human behavior, psychology, because of which trends happen and trends will continue. Gradual shift. Demand supply shifts are gradual. Gradually the demand supply shift happen. So trend can be detected. Trend can be detected. Fundamental info is absorbed gradually. Gradually means I am doing a merger and acquisition. Merger is a good merger. Market may not give the full benefit immediately. Gradually it will give benefit. If you are giving gradually, technical analysis will detect a trend and the trend will continue. Technical analysis will detect a trend and the trend will continue. Against, there are a lot of people who are against it. Who are against? One is random walk. What is random walk? Random walk theory said, what is price change? Roulette wheel. In a roulette wheel or in a dice, when you throw a dice, will number 1 come, number 2 come, number 3, 4, 5, 6, nobody knows. Similarly, in the stock market, whether price will go up, price will go down, nobody knows it. Practical world. There are people, morning they will say 9 o'clock price will go up. 9-5 another point they'll say price will go down. Both they will say and ultimately say at 9 I said price will go up, it has gone up. At 9-5 I said price will go down, it has gone down. So there is no logic at all. Price going up, going down has no logic up according to this theory. Random walk theory says it can go up, it can go down. Ultimate trend is dependent on fundamentals. Ultimately they depend on fundamental. Self-defeating. What is self-defeating is if everybody becomes an expert in technical analysis, everybody has detected the trend, everybody says buy, who will sell then? Who's going to sell? Somebody has to sell, no? If everybody has detected the trend and everybody is buying it, how will technical analysis work? Self-defeating. If everyone uses it, lag factor. A signal came, you bought, in this gap the signal is reversed. In this gap itself the signal is reversed. The signal is reversed. So people are in favor of technical analysis, people are against. They'll ask supporters and detractors of technical analysis in exam. Okay, this is, we have already done. Fundamental analysis, technical analysis. Fundamental analysis is technically investing. Technical analysis is more of trading analysis, economy, industry analysis, market data, future earning, price discounts everything, price moves in trend, history repeats. Intrinsic value, is it cheap? Is it cheap? Find trend or timing, is it moving up? Long term purpose, short term purpose. Okay, efficient market theory. We did some problem solving on efficient market theory, there was one area called run test which we did, and we also did one correlation test. What is efficient market theory? Is very simple. Is it possible to predict market? Is it possible to predict market? If somebody says no, it cannot be possible to predict market, then it is an efficient market. In that we have three form of efficiency. One is weak form, second is semi strong form, and the last one is strong form. Last is strong form. What is weak form? Is price reflect all past data. Past data means one is price, volume. Apart from that, financial statement released based on the past data. Based on the past data, you are reflecting on the price. The price is reflection of the past data. Semi strong form means price is reflecting all public information. All public information is one, price data, volume data, earnings is released by the company, price reflect the earnings. Apart from that, you are also going to reflect the future earning, future some element, your future prediction is happening. Based on the future prediction, price is already reflected in it. Strong form means all public information is also reflected, insider information is also reflected in the price. What is the net effect of this? If you have a weak form market, technical analysis no use. Why weak form technical analysis no use? Because price is already reflecting the past information. Technical analysis is on the past data. Semi strong form fundamental analysis is also of no use, because price is reflecting the past data and price is reflecting the current news. The current news, merger announced, already reflected in the price, already reflected. Strong form, which is very rare, even insider trading no use, no use. Every day market is able to predict that what is going to happen to Infosys. Infosys is going to struggle, 5% fall. Infosys will do well, 2% up. Infosys will struggle, Infosys will do well. What is going to happen in the quarter is properly predicted, strong form. India or most of the market will have weak form of efficiency, Market is irrational. There are two misconceptions. One, prices cannot fluctuate. If you have a strong efficient market, two misconceptions are there. Prices cannot fluctuate. No, prices will fluctuate. Because of new information which keeps coming in. Though it is an efficient market, but prices can still fluctuate. Market is irrational, which is more or less true. In the practical world, market becomes irrational to a great extent. What is irrational? During COVID time, everybody started selling. No new news came, but everybody started selling. One good example of an efficient market is merger announced at 10 a.m. Stock price reacted by 10 a.m. itself. If that happens, it is an efficient market. Efficient means everybody is aware what is going to happen because of the merger. Inefficient market means people are not even able to understand what is happening because of this. Is the merger good? Merger bad? Not able to understand. They are not able to understand itself. Then it becomes an inefficient market. Because why it is inefficient market? Some people, a section of people have understood that it is going to go up after 3 days. These guys will benefit out of it. This we have already done. Correlation test, run test, and filter rules test as part of the problem solving. We did it. Challenges to the efficient market. For having an efficient market, first thing is, can people understand all information? Most of the chartered accountants themselves will not be able to tell whether this merger is a good merger for TCS or a bad merger. Chartered accountants who are experts in knowledge of finance, they themselves will not be able to tell. How general public will react. General public cannot react to a news because they don't even understand what is the effect of the news. What is the effect of the news? They don't have. Irrational behavior. Irrational behavior is markets down, you should buy. What is irrational? Market down, sell. Further down, further sell. Further down, further sell. What is rational behavior? Down, buy. Further down, buy. Further down, buy. Up, sell it. Silver, irrational behavior. Went up, bought. Further went up, bought. Further went up, bought. Crash happened, down, started selling. Down, went further down, started selling. Went further down, started selling. That is called irrational behavior. And in the market, there can be some set of people who can influence the market fully. DIIs and FIIs. India is struggling because of the FIIs influence. So there is a possibility that I want to earn out of one single share. What I will do is, because of my influence, I do some 500 crore buying or selling. If I do that, the price can go down, price can go up, not because of fundamentals, not because of price pattern, but because of my influence on the market, my influence on the market. So it becomes an inefficient market. Reason is I'm able to predict what will happen, not because of technical analysis, not because of fundamental analysis, but because of my influence. Information processing. I want an efficient market. For that, everybody should be aware of information. All information awareness is there. But what will happen because of that information? Inability. I don't have the ability to absorb that information. Again, there is a problem. Irrational behavior. Irrational behavior is, if I feel silver is going to go up, irrational behavior will tell me it will continuously go up now, and I find that as a trend and start buying. And at some stage I feel no, now the irrational behavior is going to reverse and I start selling it. So efficient market is one where you cannot predict. And these are the tools available for equity research in the practical world. Somebody who wants to do equity research, what is equity research? Is trying to predict TCS growth, trying to predict India's growth, trying to predict IT sector's growth. So multiple tools are there in the practical world. I have not used most of it. I have worked on Bloomberg terminal, but most of it I have not used. So these are the tools which will give you information, past data, future data, lot of information is there. Practical world, I work in a wealth management firm. There is a tool available with us which tells us what is the GST filing done by most of the bigger companies. What is the GST filing done by? This data tells me what is the likely sales, what is the likely sales at the quarter end, what is the likely sales at a company level or at a sector level. We get it, some information comes out of the GST sales. This can tell me what is going to happen. Auto sector releases monthly sales number. This can tell me whether auto sector is likely to grow. Where will this information be there? Some of these tools can give you this information. Clear? I'm done with this chapter. Again, uh, point is technical analysis, something you see day before exam. Some of those price patterns and tools, because it can become little tricky. After reading also you are not able to do, then just live with it. 5 chapters we have done for theory. There are 10 more chapters which I'm not going to cover it in the class. I will try to give you a PPT for all of that. And what you can do for preparation is go through the summary theory itself. Summary theory or the PPT. Most of the exam student have seen question only from 5 chapters. Can questions still come from other chapter? May come. I cannot say no and all. First preference, all 5 chapters proper means very good reading of all 5 chapters. After that, time available, read other chapters summary theory, read other chapters. 5 chapters full. What are the 5 chapters were? 1, 2, 4, 7, 15. Most of the exams question have only come from this area. Apart from this, very rarely tested. So that is why I am not spending time on the other areas. These 5 chapters itself, we would have spent around 5 to 6 hours. I will give this 5 to 6 hours as a single YouTube video. Okay, you can watch it in Rio, but Rio has limitation. So I'll give it to you as a single YouTube video in maybe few days. So you can keep watching it multiple times later whenever you're writing your exam, because theory I had to cover it in the class. I could have done it at home also. I used to do it at home, but when students are in front of me, my delivery improves. So that is why I wanted to do it in the class. We are completed this. Most of you will forget what we have done in the theory. So that is why you have to go through it multiple times. PPT link, I will share it to you. Other chapters PPT will come to you. I have to prepare. The AI will give me the PPT, but I have to sit on it and make some changes. So I'll give you the PPT for all chapters. You can go through the PPT for other chapter. PPT itself will be self-explanatory. Here also PPT is self-explanatory. Only reason is I am discussing because of the importance. Clear? Any doubts on the theory part? Any doubts on the theory part? No ignoring theory. No ignoring theory. Again and again, I'm repeating the same thing because other subjects you read so much theory. This subject, attitude of the student. I don't want to prepare theory. No, please prepare theory. Recent exam. Let's see what came from the theory. One was that difficult theory question. That is so very difficult to handle. But let's see other question. Most of it will be from this area only, these chapters. Okay, this came from differentiate how real option are different from financial option, from derivatives, but this is more of a practical discussion question. We learnt about real option, we learnt about financial option. Financial option was call option and a put option. What is underlying asset? Underlying asset in a real option is the project itself. It is the project itself. There is a capital budgeting project. There was a patent valuation we did, which were real option. Payoff. What is exercise period? Shorter exercise period in normally financial option. Real option will have a longer approach. How you do valuation. So this was one out of those chapters. It was not in these chapters. A large multinational company for host country. This came from chapter 2. Chapter 2, in risk management, we had a risk called political risk. We had a political risk discussion. This came from chapter 2. This was a difficult but chapter 4. Difficult question, but from chapter 4. Explain the role of government in a sustainable startup. Chapter 15. Chapter 15 R. This is from your chapter 7, securitization chapter. They have asked a question from securitization chapter. One question outside. One question was from outside chapter. Others were from these chapters. Your September paper, September 2025. 30 marks initially will be your MCQs. List the steps involved in business succession strategy. Chapter 15. Chapter 15, mandatory question. This was the mandatory question. So 100% you have to answer it. This was question 1. Mandatory question. Identify the key points that make an organization sustainable, done in chapter 1. Chapter 1, part of the important chapter list. Blockchain technology, chapter 7. Every question has it. Every question has one theory question, has one. I'm showing this because at least now you will get serious. Otherwise, seriousness is not there for reading theory. People feel I will go without theory. Then you have to score 60 out of 80. Mentally be prepared. 60 out of 80 you have to score, not 60 out of 100. And don't tell me you'll score less than 60. It will not work, because in your group 1, most of the time auditing pulls down the marks. AF and FR has to take care of your marks. So 60 is what we mentally have to be prepared. Question 4. Technical analysis has supporters and critic. We just now saw supporters of technical analysis and detractors of technical analysis. This came as question number 4C. Every question has one theory or other question, internal choice. What are the parameters to identify currency risk? Chapter 2. Chapter 2. 5 did not have a theory question. 6 did not have a theory question. So 1, 2, 3, 4. If you answer 1, 2, 3, 4, 3 out of 4, you have to answer theory. So 3 into 4, 12 marks. 3 into 4, 12 marks of theory you have to answer. 12 marks of theory you have to answer. I'll just show maybe one more paper, May 2025. Mandatory question. Mr. PK imports raw material. What type of risk? Chapter 2, we have learnt this. We have learnt this as part of chapter 2. Mandatory 4-mark question. Role of CFO in addition to traditional role, chapter 1. Chapter 1, part of the important question. Again, a theory question has come. Weak type of efficiency, various type of test. We saw correlation test, we saw filter rules test, all that got tested as a 4-mark theory question. Tokenization resembles the process of securitization, chapter 7. Venture capital, chapter 15. Chapter 15. Five, no theory. 6, no theory. So 1, 2, 3, 4 had a theory element. 1, 2, 3, 4 had a theory element from the mandatory chapters. Most of the time it will be from the mandatory chapters. I think there was one paper where theory was not tested much, which was May 2024. That's an exception paper. November 2024. Question 1C. Decision determines the division of earnings between payment to shareholder and reinvestment. Question in chapter 1. This is in part of chapter 1. Succession planning, chapter 15. Chapter 15. Okay, I think this paper, no major theory was tested. Okay, this is the paper, no major theory was tested. Only 2 questions were tested. But again, mandatory question has a theory. 100% we have to answer. Apart from that, other areas will also have theory. Again and again, I'm repeating. Don't ignore theory and go to exam. Don't ignore theory and go to exam. Then you will start saying that ICI awarded 58 marks. I wanted only 2 marks. You did not answer any theory. How will you secure that extra 2 marks? You are unnecessarily missing out if you don't answer theory. So 5 chapters, full reading. 5 chapters, full detailed reading. Multiple times you read it. Multiple times get clarity. One approach which I had said earlier also, sit in a calm room, do your own recording of whatever you want to do with the summary theory or with the PPT. Do your own recording and keep hearing it multiple times. Keep hearing it multiple times. Still you get full clarity on it. No by hearting. I'm not getting into by hearting part. I'm trying to tell you the logic, but still some memory power will be needed here. Clear? Okay, let's take a break now.